reporting and analysis. So in this session, I want us to look on an illustration question regarding accounting for the conversion of a partnership into a limited company. And I want us, first of all, we go through that particular question and we see what was required. So the question reads, Chada, Pete, Kidore are partners in a partnership business, sharing profit and losses in the ratio of 2:2:1 respectively, after allowing for a 10% per annum interest on fixed capital balances and commission entitled to a partner. The following trial balance was extracted from financial record of partnership as at 30th of September 2017 is as set below. So we are given the trial balance there for partnership as at 30th of September 2017. So the first item, we have landed buildings at cost, motor vehicle at cost, office equipment at cost, furniture and fixtures at cost. And then we have the provision for depreciation for buildings, motor vehicle, office equipment, furniture and fixtures. So this is the accumulated depreciation for those particular assets. Then we have investment. We have goodwill, inventories as at 30th of September 2017. We have account receivable, account payable, bank overdraft, accrued expenses, a capital account for Chada, Pete and Kidore. And then you're given the net profit for the year which ended 30th of September 2017. We have the drawings by the three partners, Chada, Pete and Kidore. And then we have the current account for the three partners, Chada, Pete and Kidore. Then we have some additional information, note 1 up to note number 3. Note number 1, we are told that Kidore was the only active partner and was entitled to a commission of 15% on annual sales revenue, which averaged to 20 million. So, and then you're told that number 2, the partners resolved to convert their business into that of a company to be named Chapeki Limited with effect from 1st October 2017 under the following terms. 1, we are told investment comprised equity investment which partners had acquired jointly. Each partner was to take over a portion of the investment equivalent to the profit share. The investment had a market value of 50 million as at 30th of September 2017. The other point, you're told other assets and liabilities were transferred to the new company at the following agreed values. Landed building 115 million, motor vehicle 25.5 million, office equipment 43.5 million, fixture and fittings 29.55 million, and then inventories at a book value less 5%, account receivables at book value less 2.5%, and then we are told current liabilities were transferred now to the company at their book value. We are told goodwill was considered valueless and therefore was written off. And then you're told the purchase consideration on business purchase was agreed at shillings 250. And the last point of note number 2, we are told the partners were to become shareholders. The company issued ordinary shares at par of shillings 10 each to the partners to satisfy the balance due to them as at 30th of September 2017. And in the last point, number 3, we are told upon incorporation, the new company issued new debentures at par carrying a 14% per annum. And then you're told the cash proceeds from the issue amounting to 50 million were utilized to purchase additional stock of raw materials, additional stock of raw materials worth 15 million, and then you're told accrued expenses were settled in full. So what you are required from this particular question 1 is we prepare the realization account, partners capital account and Chapeki Limited account to cross off the partnership books, and finally we are required to prepare opening statement of financial position of Chapeki Limited. This is a question for conversion of partnership into a limited company. Basically what we said in our first lesson is that whenever a partnership business has been converted into a limited company, the first thing we need to do is to cross off the books of account of the partnership business, simply because that partnership business is dissolved. And actually, we said we prepare three main accounts: realization account, partners capital account, and the purchasing company account. Like in this case, the purchasing company is known as Chapeki Limited. Those are the three main accounts which we prepare to cross off the books of account of the partnership. And actually, that is what the examiner was requiring as far as Roman 1 of that question is concerned. And then from there, we proceed and then do what? Open the books of account of the new what? A company. So therefore, what we need to do is to start with Roman 1 of that question, whereby we are required to prepare a number of accounts. So the first account we are required to prepare is the realization account. Realization account, that is the first account we are expected to prepare here. And the realization account, basically this is prepared using a T format. Also in Roman 1, we are required to prepare a partners capital account. Partners capital account. Partners capital account. Equally, this is a T account. A T account. So meaning that this account will be having a debit and a credit side. And on the credit side, we are going to have the details column and columns equal to the number of partners. In our case, we have three partners. That is, we have three partners, Chada, Pete, and Kidore. The same case with the debit side of this particular account, we have three columns for the three partners. This is the debit side, credit. The same case with the partners capital account. So this is the details column, and then we have three partners, Chada, Pete, and then we have Kidore. The same case on the debit side, Chada, Pete, and Kidore. And equally in Roman 1 of that particular question, what the examiner was requiring us we prepare is another account which is called Chapeki Limited. So remember, Chapeki, this is a new company, and basically the new company we refer to it as purchasing company. Reason being that this particular company is purchasing the business of the partnership. So therefore, we have the other account which is Chapeki Limited account. Chapeki Limited, but which you are saying is the purchasing company account. Purchasing company account. So those are the three accounts which the examiner requires to be prepared as far as Roman 1 is concerned. And these accounts basically are prepared in order to cross off the books of account of what? Of the partnership. So what we need to do before we cross those particular accounts of the partnership, maybe we can just go through the additional information. We see what we are told. And number one, you're given some information about the commission which Kidore was to be entitled to, which you're told it was 15% of the sales revenue. And we are told Kidore is entitled to that commission because he was the only active partner. Being active partner means that Kidore is the one who was running the affairs of this particular partnership business. So we have that information. And then in number two, we are given now the information or the terms of conversion, the asset which were taken over by the new company, the asset which were taken over by the partners, the purchase consideration, and so on. So therefore, what we need to do, or anytime you come across such a question for partnership and whereby the conversion is taking place at the end of the year, the first thing you need to do is to distribute or basically to appropriate the profit which was reported by this particular partnership business among the partners, partners. Once you're through with that, then proceed and you cross off the books of account of what? Of the partnership. And basically, in this case, we do that by preparing something called the appropriation account, so that we can be able to do what? To distribute now that particular profit which was reported by the partnership business among the partners. So therefore, let's first of all we do that. Before then, we can proceed and cross off the books of account of this particular partnership business. It is also important for you to note that the figures which are given in the trial balance are in thousands of shillings. So therefore, what we need to do first of all, we take the net profit which was reported, the net profit for the year, and the net profit for the year in our case we are told is 91,000. So remember, take into account this is a partnership business. This profit which was reported during that year should be shared among partners. But before sharing out that particular profit, there are a number of things we need to deduct from this particular profit. Things like interest on capital, things like salaries to partners, things like commission to partners, and so on. So in our case, what you're given in the additional information, number one is the commission to Kidore. So mean that here we less now the appropriations. So the first appropriation we are going to less is the commission to partners. So in our case, we know that it is only one partner who is entitled to a commission, and that is Kidore. Kidore was entitled to a commission equal to 15% of the sales. And in this case, we are told the sales for that year average to how much? Average to 20,000. So we get 15% of that, and automatically that should give us 3,000. Let's just confirm whether that will give us 3,000. So 15% of 20,000. Yes, that will give us 3,000. So this is a commission now which Kidore was entitled to. The other appropriation which we deduct from this is salary to partners. Salary to partners. As per the information which are given in this particular question here, there is no partner who was entitled to a salary. But if any of the partner was entitled to a salary which is an appropriation, we also deduct it here. The other appropriation which we deduct here is something called the interest on capital. Interest on capital. There is some information which are given regarding this, which is in note number or in paragraph 1 of that particular question, whereby we are told partners were sharing profit and losses in the ratio of 2:2:1 after allowing a 10% per annum interest on fixed capital balances. So mean that the partners were entitled to an interest of on capital equal to 10%. So let's compute the interest on partners, or the interest on capital that is for each partner. For a Chada, which will be 10% of his capital. Then we have Pete, equally 10% of his capital. And then the last partner, who is Kidore, equally 10% of his what? Of his capital. So how much is the capital balance for each partner? We have that is in the trial balance. And the capital of Chada here was 58,500. For the other partner, it was 37,000. That is Pete. And the other partner, that is Kidore, we have an amount of 31,500. So what we need to do, we get 10% of this. So this will give us 58,50. This will give us is 37. It will give us 3,700. And then this will give us 31,50. So we get the total. We take it to the last column. So the total figure here will be 58,50. 50 plus 3,700 plus 31,50. That will give us 12,700, and equally that one should be deducted now from our net profit. Now, after deducting those three items, that is the commission to partners, the salary to partners, the interest on capital, the amount now which remains here, or basically the balance which you get, if a positive figure is a profit to be shared, but if it is a negative figure, is a loss now to be shared. In our case, I hope you can see here, definitely you are going to have a positive figure. So this minus those two figures, we are going to have a positive figure. We less from 91,000, we less 3,000 and 12,700. Yes, that will give us a positive figure of 75,300. Now, this particular figure here, this is a profit now to be shared by partners or to be shared among the three partners using their profit and loss sharing ratio. So, therefore, we have the share of profit, and this profit will be shared by the three partners. Chada, I think we can just use C for Chada, P for Pete, and K for Kidore. And this particular profit will be shared based on their profit and loss sharing ratio. As per the information we have in the first paragraph of that particular question, we are told that the partners were sharing profit and losses in the ratio of 2:2:1. So we need to get the total for that, which is 5, and the share of Chada is 2/5 times that figure, that is 75,300. The same case with Pete, 2/5 times 75,300, and then finally Kidore, 1/5 times 75,300. So that will give us now the amount of profit which each partner was entitled to. So the first partner, we take 2/5 times 75,300, and that will give us 3120, and that's the same for the other partner. And the last partner will be entitled to a share equal to a profit share equal to 15,060. So then once we add all this, it should give us now this particular amount here, that is 75,300. Yes, and basically after deducting now these three items now from our profit there, we should get now 0. Maybe you can just confirm 91,000 minus 3,000 minus 12,700 minus 75,300. Yes, so that should give us 0. So that is the first thing you do. You take the profit now which was reported by the partnership, and then you do what? You distribute it among the partners. And once you do that, then you go back to the trial balance, and basically you cross off all those particular accounts which had balances at the end of the year, starting from the first item there, which is land and building. But even before you do that, you have to remember, we say that in preparing this particular account, there are a number of things which you record here. For example, when we say that all the assets which are taken over by the new company at their net book value, we debit them in this particular account. The other item, or basically on the other hand, we say that those particular assets which are written off, those particular assets which are taken over by partners, we debit them in this particular account. Also, in the realization account, we credit the liabilities which are taken over by the new company, and also in this particular account on the credit side, we record now the purchase a consideration. So therefore, what we know as per the information we have in or as per the information we have in note number 2 is that a number of assets, including land and buildings, motor vehicle, office equipment, furniture and fixtures, inventories, account receivables, all those particular assets were taken over by the new company. So therefore, all those particular assets which were taken over by the new company, what we do is that we debit them in this particular we debit them in this particular account here. We debit them in this particular account here. The first asset is land and buildings. Land and buildings, and we debit that particular asset here at its net book value. So what will be the net book value? The net book value will be equal to the cost, which is 123,500, minus the accumulated depreciation, which is 20,150. So that will give us now the net book value. We're going to compute that. The other asset is motor vehicle. So the net book value is 80,600 minus the accumulated depreciation, which is given as 54, 600. The other asset which was still taken over is office equipment. The net book value will be 70,200, which is the cost, minus accumulated depreciation, which is 24,400. The other asset which was taken over was furniture and fixtures. The net book value will be 52 minus the accumulated depreciation of 18,500. So these are basically the assets now which were taken over by the new company, and those particular assets we have said in this particular account we debit them. We debit them at the net book value. At the net book what? A value. So let's compute the net book value of this particular asset, starting with the first one, which is landed building 123, 500 minus 20, 150, which will give us 103, 350. The other one is a motor vehicle. We have 600 minus the accumulated depreciation of 54,600, which will give us a net book value of 26,000. So the other asset is office equipment, whose cost is 7,200 minus accumulated depreciation of what? Of 24,400. That will give us 45,800. And then we have the other asset, which is furniture and fixtures. The cost is 52,000 minus accumulated depreciation of 18,500, and that will give us 33,500. Yes. So we are through with those particular accounting for those particular assets which were taken over by the first of all, those particular non-current assets which were taken over by the partnership, and then below those particular assets, remember I've said we cross off those particular accounts. Don't skip any account. So then from there we go, remember you have dealt with those particular accumulated depreciation. Then from there we go to the investment. So there is some information we are given regarding those investment in point number 2. In addition information number 2.1, we are told investment comprised of equity investment, which partners had acquired jointly. Equity investment means that this is an investment in shares, and the partners had acquired those particular shares what? Jointly. So we are told each partner was to take over a portion of the investment, equivalent to the profit what? Share. And then you are told the investment had a market value of 50 million at on 30th September 2017. So this particular investment, which we are told include investment in equity shares. So in the statement of financial, in the trial balance, you can see that this particular investment had a book value of what? Of 44,800. But you are told this particular investment at the end of the year had a value of how much? 50,000. So automatically, this particular investment will be shared by partners at their market value. The market value is how much? 50,000. So, but now the difference here, which is the difference between 50,000 and 44,800. So this one, which is 52, is what? Is a gain on investment, or basically we can refer to it as a revaluation gain on what? On investment. So how do we account for that? So remember, investment, this is an asset. So therefore, the amount which was recorded in this particular account was an amount of how much? 44,800. Yes. So therefore, what we do, because we need to cross off that particular account, take into account those particular investments were taken over by partners. So we credit this particular account with that particular amount, 44,800, and now this particular gain of 5,200, this will be credited in this account. This will be credited in this what? Account. So basically what that means is that the double entry for this particular investment shared by partners, one, we debit the partners capital account at an amount of 50,000. Then we credit to account the investment account with an amount of 44,800. That's what you have said there. And then with the gain, which is the revaluation gain of 52, this would be credited in the account called what? The realization account. The realization what? Account. So therefore, the entries which we need to make here is what is affecting realization, So 5,200, we can refer to that as the revaluation gain on investment, which is a figure of 52. So we are not required to prepare the investment account, and then the other entry which we need to make is to debit the partner's capital account with an amount of how much? 50. Remember, we are told that that particular investment will be shared among partners using their profit and loss sharing ratio. The profit and loss sharing ratio we know is 2/5, 2/5, and 1/5. So therefore, we debit this particular account with the investment which was taken over by partners. And basically we take 2/5 times what? 50,000 for Chada and Pete. So this will be 10, and that will give us 20,000. And then for Kidore automatically will be what? Will be 10. So that is now how we account for those particular assets which are taken over by partners. We said debit the partner's capital account, credit the specific asset account. So then below investment, we go back to the trial balance. Below investment, we have goodwill. And equally, there is some information we have in note number 2 regarding goodwill, whereby we are told goodwill was considered valueless and was therefore written off. Equally, we say that those particular assets which are not taken over by the new company but they are written off, we credit the specific asset account and then we debit the partner's capital account, equally using the profit and loss sharing ratio. So take into account goodwill was written off, that one will be debited in this account and then credited in a specific asset account using the partner's profit and loss sharing ratio. So the profit and loss sharing ratio for Chada and Pete we know is 2/5. 2/5 times the value of goodwill. So in this case, the goodwill had a value of how much? 26,000. So this will give us what? Let's compute that. We have 26,000 divided by 5. So this will give us 52 times 2. So which will give us 10,400. 10,400 for Chada and Pete, and then 5,200 for the other partner. So with that particular goodwill, then from there we have 2 other assets there. We have inventories at the end of there and account receivables. If you go to note number 2, we are told inventories and also account receivables. These are the other assets which were taken over by the new company. Any asset taken over by the new company, the books of account of the partnership, or when crossing off the books of account of the partnership, you debit such asset in this account at the book value. The book value is the value in the trial balance. So we have inventories. The book value, the value in the trial balance is 31,200, and then we have account receivables. Account receivables with a book value of what? With a book value of 25,400. So we are through with those 2 current assets, and then from there we have bank overdraft, accrued expenses, including account payable. There is some information we are given still in note number 2, where we are given the terms of conversion, where we are told all current liabilities were transferred to the new company at the book value. At the book what? Value. And actually those 3 items, account payable, bank overdraft, accrued expenses, all those are current items of current liability. So those 3 items of current liabilities were transferred to the new company. So we said in closing of the books of account of the partnership, those particular liabilities which are transferred to the new company, what we do is that we credit them in this account, in the realization account at the book value. So we have 3 current liabilities there. Account payables, the book value for that is 62,400. We also have bank OD, bank overdraft. The book value for that is 17,550. And then we have accrued expenses, having a book value of 4,000, having a book value of what? 4,000. So those are the three current liabilities which were taken over. And then from there we go to the other item, which is the partner's capital account. The partner's capital account is crossed off to this particular account. And you can see the partner's capital account in the trial balance is having a what? A credit balance. So therefore that is the first, or basically that one we cross it off in this account and we record it on the credit side. The capital account balance for the first partner is 58,500, for Pete that is 7,000, and then for the other partner who is Kidore is an amount of 500. So we are done with that, and then from there we have now the profit for the year. The profit for the year, we don't record it in either of these particular accounts, but what we account for is these appropriations, this particular amount which has been distributed to partners, because you can see this profit for the year was distributed among partners. That's what we account for. And all these items here, all these appropriations, they are recorded in this account, the partner's capital account. Anything which a partner is entitled to, including commission, including salary, including a share of profit, including interest on capital, all those items in this account, we do what? We credit them. So let's start with the commission. Commission in this case, it is only one partner who is Kidore who is entitled to a commission of 3,000, and then we have now salary. So we don't have salary, but in the event you had salary to partners, you equally credit it in this account. And then next we have interest on capital. Interest on capital for Chada 5850, that is 700, and that 150. So we are through with that. And then finally we have the share of profit. Share of profit. So therefore I've said all appropriations, we credit them here. So we have 30, 120, 30, 120, and 15, 0, 60. So we are through with that. Let's go back to the trial balance. Below the profit for the year, we have drawings. Now the drawings, basically that one in this account is supposed to be debited. The drawings to partners, we have the drawing for Chada 78, for the other partner 6,500, and for the other partner 39. And then finally we have the partner's current account. Now the partner's current account, equally we cross it off to the partner's capital account, and you can see those particular current accounts, they had credit balances. So we take those particular credit balances, we bring them in this account on the credit side. If the balances, if any of the current account is having a debit balance, that should be recorded on which side? The credit side. But none of the current account there is having a debit balance. So all of them are credit what? Balances. That's why we have said we cross them off in this account on the credit what? On the credit side. On the credit side. So basically in our case, you can see what you have done. We have crossed all items which had balances at the end of the year, either in the realization or in the partner's capital account. Then let's go through the additional information. We see whether there is anything we need to capture here. So I think we have dealt with note number 1 about the commission to Kidore. Note number 2, whereby we are given the terms of conversion. We have accounted for the investment which were taken over. We have accounted for the other assets which were taken over, including landed buildings, motor vehicle, office equipment, fixture and fittings, inventory, account receivables. We have also accounted for current liabilities which were taken over, which included account payable, bank overdraft, accrued expenses. We have also accounted for the goodwill which was written off. And then we have also, okay, there is something we are yet to account for there, that is purchase consideration. We say that this purchase consideration which was agreed upon, or the purchase consideration now which the partners are supposed to be paid, that one is debited, not debited, rather credited in the realization, and is an amount of 250 million. We credit it in this account, and then we debit it in this account here, which is called purchasing company account. Remember, all our figures here are in thousand of what? of shillings. So we have the purchase consideration, an amount of 250,000. So we are through with that. And then we are told the partners became shareholders and were issued with the share. So basically what that means is that this particular purchase consideration will be paid to the partners of the partnership business by being issued with the shares of the new company. So automatically what that means that those who are partners, that is Chanda, Pete and Kidore, will equally become the shareholders of the new company, because they will be paid the amount due to them in terms of being issued with the shares. And then note 3, we are given information. We are told upon incorporation, the new company issued debenture. So these are a transaction by the new company, not by the partnership. So therefore, in our case, I think first of all, we are through with preparing these three accounts. So what we need to do now is to balance off this account. But the first thing which we do is to balance off this account, and the balancing figure in this account is either a gain or a loss on realization. A balancing figure on this side is a loss on realization. A balancing figure on this side is a gain on realization, which is equally shared among partners using their profit and loss sharing ratio. So let's balance this particular account here. Let's balance this account. So let's start by getting the total on the credit side. We have 5,200 plus 62,400 plus 17,550 plus 4,000 plus 250,000. So that will give us a total of what? A total of 339,150. What about the total on the credit side? We have 103, 350 plus 26,000 plus 45,800 plus 33,500 plus 31,200 plus 25,400. So that will give us a total of, this is the total on the credit. The total on the debit is 265,250. So basically what that means is that the amount which is more is the amount on the credit side, which is 339,150. 339,150, and that means that we have a balancing figure on this side, and I've said a balancing figure on this side is what? Is a gain on realization. Is a gain on realization, and that gain on realization is shared among partners using their profit and loss sharing ratio. Gain on realization. This will be shared between the three partners, that is Chada, Pete and Kidore, using their profit and loss sharing ratio, which is 2 all over 5, 2 all over 5, 1 all over 5 times now the gain on realization. So the gain on realization will be the difference between those two figures, which is 73,900. 73,900. 900. Yes. So let's determine the amount to be shared, or the share of each partner. So here we have what? We have 29,560. 29,560. Okay, no. That correct? Yes, 29,560. And then we have 14,780. 14,780. Okay. Yes, we can just confirm whether that is correct. Yes, that will give us what? That will give us 73,900. So this particular amount, which is shared among partners, then it is crossed off to this particular account. You can see this account is being debited. So what we do to complete the double entry, we credit this account, the gain on realization. So we have 29,560, 29,560. And then for the last partner, who is now Kidore, we have 14,780. So once we do that, then equally we come and balance of this particular account. We balance off this particular account, and the balancing figure now in the partners capital account is the amount due to partners. So, or in other terms, it is the amount to be paid now to each of the partner. And basically the total amount to be paid to all partners must be equal to this particular purchase what? Consideration. In terms of how we account for that purchase consideration to be paid to partners, the purchase consideration to be paid to partners, we debit that particular amount in this particular account there, and then we credit this account. We credit what? This account. So let's compute now, first of all, the amount to be paid to Chada. We get the total on the credit side. We less what we have on the debit side. So we have 58,500 plus 5850 plus 30,120 plus 20,800 plus 29,560. And then we less what we have on the debit side here. We have 20,000, we have 10,400, and then we have 78. Yes, that will give us 106,630. So we debit it in that particular account, and then we credit this one. So you have the purchase consideration, which was paid to who? To Chada. And that is an amount of 106,630. 106,630. So we do the same for the other partner. We do the same for the other partner, who is Pete. Equally, we add the total on the debit side, we less what we have on the, we add the total on the credit side, we less what we have on the debit. So we have 37,000 plus 3,700 plus 30,120 plus 18,200 plus 29,560 minus now what we have on the debit, which is 20,000 minus 10,400 minus 65. Minus 65, and that will give us 81,680. We do the same to the last partner, who is Kidore. So we add whatever you have on the credit side of that account, that 1,500 plus 3,000 plus 3,150 plus 15,060 plus 13,300 plus 14,780. 780. Okay, and then we less what you have on the debit side. We have 10,000, we have 5,200, and then we have 3,900. 3,900. That will give us 61,690. Yes. So let's record now that purchase consideration here. The amount paid to Pete, as per our computation there, is 81,680. The amount paid to the other partner, who is Kidore, is 61,690. So basically this particular account now here should automatically balance. So whatever we have on the debit side is 250. Then let's confirm whether whatever you have on the credit side will come to the same. 61,690, 81,680 plus 106. 630. Yes, automatically that will come to what? That will come to 250,000. So basically that's what the examiner was requiring as far as part 1 of that particular question is concerned. And therefore, as far as the first account is concerned here, that is the realization account. These are the entries. These are the items which were being marked there. Those are the items which were marked. In the partner's capital account, these are the entries now which were earning you the marks are located there. All these, you can see we have so many entries here, and as far as this account is concerned, Chapeki Limited, the purchasing company account, those are the items which were to give you some marks. So in our case, we have done what? We are through with Roman 1. We have crossed off now the books of account of what? Of the partnership. So let's move to Roman 2 of that particular question. We are required to prepare opening a statement of financial position of Chapeki Limited. But before we do that, there are some accounts we need to prepare. The first account we need to prepare is something called the business purchase account. Business purchase account. This account is prepared to determine whether the company acquired or purchased the business of the partnership at a goodwill or a negative goodwill. So how do we prepare this account? This account here, that is a business purchase account, one, we credit it with the asset taken over. We credit this particular account with the asset taken over at their fair value, not the book value. The fair values is what we have in note number 2. Then this account here we debited with the liabilities which were taken over. In this case, whenever the liabilities are taken over by the new company, always liabilities are taken over at the book value. Liabilities are not revalued. And then we debit this account with the purchase consideration. In our case, we know the purchase consideration was 250,000. So we can just record that here directly. And then for the liabilities which were taken over, we know there were 3 liabilities. 3 liabilities. We have them in this account, that is in the realization account on the credit side. So I think we can just get the total for those 3 liabilities which were taken over. So we have 62,400 plus 17,550 plus 4,000. So this will give us what? 83,950. So that is the total value of the liabilities which were taken over. 950. Yes, because we have 62,400 plus 17,550 plus what? Plus now a figure of 4,000. Then let's get the total value of the liabilities, of the asset which were taken over. Asset which were taken over at the fair value. And basically that information is given in note number 2. So I think we can have a summary of the assets now which were taken over, so that we can get now the total. So which are those particular assets which were taken over as per note number 2? We have land and buildings. Land and buildings taken over at a value of 115,000. We have motor vehicles taken over at a value of 25,500. We have office equipment taken over at a fair value of 43,500, and then fixtures and fittings taken over at a fair value of 29,550. And then we also have inventories taken over at the book value less 5%. In other terms, it means that the inventory were taken over at a value equal to 95% of the book value. So we know the book value of inventory, we have it here as 31,200. 31,200. Still, as per that point, we also have account receivables, which is still an item of current asset, which was taken over at the book value less 2.5%. In other terms, account receivables were taken over at a value equal to 97.5% of what? Of the book value. What is the book value of account receivables? Is the figure we have there, 25,400. 25,400. And therefore, as per the information we have in note number 2, those are the assets which were taken over by the new what company and at their book value. So let's get the total fair value of those assets taken over. But let's first of all we compute the value at which inventories and account receivables were taken over at. We have for inventory 95% of 31,200, which will give us 29,640. What about account receivables? 97.5% of 25,400, which is 24,765. So what we just need to do is to add all those particular assets which were taken over at the book value, at their fair value. At the fair value, 29,640, 29,550, and 43,500 plus 25,500 plus 115,000 plus, yes, I think that is the last figure there, 25. Oh, sorry. So we need to take that afresh. So we have 115,000 plus 25,500 plus 43,500 plus 29,550 plus 29,640 plus 24,765. So that will give us a total figure of 267,955. So therefore, that is the total value of the asset which were taken over. And then from there we balance our account. So any balancing figure in this account on this side is a goodwill, which is an asset to the company. A balancing figure on this side is a capital reserve, which is a component of equity to the company. So on that side we have that figure, and then what do we have on the debit side? On the debit side we have 250,000 plus 83,950. So automatically the total on the debit side is more, with 333,950, 333,950, meaning that the balancing figure is a goodwill here of how much? 267,955. Yes, so which is 65,995. So this particular goodwill we are saying is an asset to the company. So I think having done that, we can now proceed and we finally prepare what is required in Roman 2 of that question, the opening statement of financial position of Chapeki Limited. Roman 2. Statement of financial position of Chapeki, and this is the opening. In other terms, it is a statement of financial position as at the start of the year. So always we start by recording non-current assets. So this one is quite simple because we have all items of non-current asset which were taken over by the new company from the partnership, and basically that is what we have here. That was this summary was quite important. So we have Raded Buildings, which was taken over at a value of 115,000. We have motor vehicles taken over at a value of 43.5. Is it 43.5? That is for equipment. For motor vehicle is this one, 25,500. Then below that we have office equipment taken over at a value of 43,500. Then we have furniture and fixtures. Fixtures taken over at a value of 29,550. Yes, so we have branded buildings, motor vehicle, office equipment, fixture and fitting. So these are items of current assets. And then the other thing we need not to forget is the goodwill arising on business purchase. This goodwill which you have computed there of 65,995. And then next, what we do is to record the current assets. So for the current asset, we can start with what we have here. We have inventories. So for the inventories which was taken over, it had a value of 29,640. But you also have to remember the information or what you are told in additional information number 3, that this particular company issued some debentures which had a value of 50 million. And out of that particular cash which was received of 50 million, this company acquired additional raw materials or acquired additional inventory having a value of 15 million. So therefore, the value for inventory will automatically do what? Increase. So therefore, we need to add the two figures which will give us what? 44,640. And then the other item here is account receivables. The account receivables, which is how much? Which is 24,765. 24,765. Then also take into account our company here issued some debentures having a value of 50 million. It means that our company raised some cash. So therefore, we need to prepare the bank account so that we do what? We determine the bank balance. We prepare the bank account. So first of all, when preparing this bank account, the first thing we record is the overdraft, which was taken over, of which an overdraft in this account always should be recorded on the credit side. The overdraft was having a value of what? 17,550. And then from the information we have in note number 3, this company issued debentures, issued 14% debentures, and our company raised how much? 50 million. So that amount received by the company should be debited in this account because this cash received. And then also we are told our company did two things from this cash. One, our company purchased additional inventory having a value of what? 15,000. And also the company paid the accrued expenses which were taken over from the partnership. I hope you can remember the accrued liabilities taken over had a value of how much? 4,000. So what that means is that we balance that account, we determine what was the bank balance, what was the cash in the bank at the end of the year, or basically at the start of the year. So we take what we have on the debit side, which is automatically more, minus 17,550, minus 15,000, minus 4,000. So that means that there was a bank balance of 13,450. So this is the cash which was in the bank, and it is a component of current asset, 13,450. And then from there, what do? We get the total assets. The total assets. We add everything which is here. So the total assets, the total assets, I think we have gotten the total here. And this total included what? Included this, that, excluding what? The goodwill. Also include, this, excluding now the amount of 15,000. And then also included that, didn't include that. So therefore, to this figure here, 267,955, instead of adding those particular items again, we need to add the goodwill, 65,995. What else is not included here is this inventory of 15,000. So we add 15,000, and also we add now the bank balance, which is 13,450. So let's add those figures. We have 267,955 plus 65,995 plus 15,000 plus 13,450. That will give us a total asset of 362,400. So those are the total assets. Then from there, we proceed, we record the financials. And because this is a company, what we record here is equity. Equity is share capital and reserves. So the first thing we need to record here is the company's ordinary share capital. And what we know is that our company here, which is Tapeki Limited, was to pay the partners a total amount of 250,000. I hope you can remember that as per the information given in note 2. And then we are told that amount which was to be paid by the new company to partners was to be paid by the new company in terms of issuing shares. So mean that this company issued shares which had a value of how much? 250. So in this case, we don't have any other item of equity, but after preparing this particular account, if you got a capital reserve, that capital reserve, we bring it here as a component of equity. And in our case, we don't have either any. So then next, what do we record? Non-current liabilities. Non-current liabilities. Is our company having a non-current liability? Yes, we have to remember our company issued 14% debentures. These debentures to this company, this is what? This is a liability, a non-current liability, having a value of what? 50,000. And finally, we record what? The current liabilities. We record the current liabilities. Current liabilities. So in our case, what we know is that our company here, that is Tapeki, took over 3 liabilities from the partnership. Which were those liabilities? We have account payable, we have bank overdraft, and then we have accrued expenses. But basically what we know first of all, as per the information we have in the last sentence of note number 3, is that this accrued liability was paid. And also from the bank account which I have prepared here, we have seen that this bank overdraft was also repaid because there was money which was raised by the company from the issue of this word debenture. So therefore, the only current liability which remained is account payables. Account what? Payables. What is the value for account payables? Is 62,400. 62,400. And then from there, what we need to do is to get the total equity and what? And liabilities. Total equity and liabilities. So the total equity and liabilities, we add what we have here. This is 300,000 plus 62,400, which will give us 362,400. You can see whatever you have there is basically the same with what? The total asset. The total asset. So therefore, that is it, that what was required as far as that particular question for conversion of a partnership business is concerned. And that brings us now to the end of that particular topic, which is accounting for conversion of partnership business into a limited company.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and today, ladies and gentlemen, we are discussing about the Business and Data Analytics August 2023 paper. The question of focus today is question 22. It reads as follows. Riziki Limited is considering a project with the following details. Initial cost 40 million, residual value 2.5 million, selling price per unit is 1.1, variable cost per unit 500, I meant 1,100, pardon me. Then variable cost per unit is 500, fixed cost per year is 5 million. Additional information, annual number of units sold is 30,000. The project has a useful life of 5 years. The company uses a weighted average cost of capital or WACC of 12%. Required, A, compute the base net present value. B, carry out a sensitivity analysis of NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. C, prepare an appropriate chart to indicate the different NPVs for each scenario in B above. Note, adverse variances in this case means a decrease in cash inflows or an increase in cash outflows. So what we're going to do, ladies and gentlemen, you can see towards the right of the screen over here that we've developed inputs: the initial cost, the residual value, the selling price, the variable cost per unit, and the fixed cost per year, and the project life there. So what we're going to do then, we're going to now identify the inputs, of the major inputs towards the right. Like for example, what I mean is this: we're going to now talk about the base. Here we're going to talk about the base case, input based on the input. So base, that, and then towards the right we're going to include a 5% initial cost, or positive value of 5% initial cost. So we're going to have plus 5% initial cost, like that, and then we will now then have the adverse scenario, where we have negative 5% annual unit sales. So negative, I'm going to do like that, negative 5% annual unit sales. So with that, we proceed on to get or to also identify now the 5% selling price. So negative 5% selling price. Then we continue building on the model itself. Right here we have variable cost. Now, increase in variable cost, 5% variable, 5%. I'll explain variable cost, and then we're just following these components right over here. So we began with the initial cost, then we went to the annual unit sales, then the selling price, then you're going to the variable cost over here of 5% variable cost, and then residual value there. So negative 5%, negative 5% residual fixed cost. I think I forgot fixed cost. So positive 5%. Apologies for that. Positive 5%. 5% fixed cost. And then we're talking about residual value right here. Residual value. %, residual value. That. So with that, we are saying that we are told to compute the NPV. So the inputs, then we just follow the inputs based on whatever we've been given. So the residual value right over here, we can come to the initial cost. You can see the initial cost is 40 million over here. So it's 40 million. We're just doing the base case scenario over here. So what I can do, I can put this perhaps on that side like that. So that now, and maybe perhaps I can, with your permission, I can just compress it a bit over here like that, so that you can be able to fill out this part. So the initial cost right here, you can see is 40 million like that. So 40 million. And we come down there. So we want the comma format, guys. The comma format. So we highlight everything, put a comma, then just like that. So here the initial cost plus that value there. Then we have the residual value going down. The residual value is given to us over there, that value there, because we're talking about the base case. And then the annual unit sales. The annual unit sales you can see is right here, additional information number 1, so 30,000. So just put plus 30,000, because this is in words, it's not separated from the words, so it's in figures combined with the words. So just put 30,000 there. We have the selling price per unit given to us. The selling price per unit, you can see, is given to us on the right here. So enter that. The variable cost per unit as well, given to us there, enter. Then the fixed costs per year have also been given to us there. So plus, enter there. The project life in years, we have been told in note number 2 that the project has a useful life of 5 years. So we just indicate here 5. That. So what happens then when we have an increase on initial cost? So the increase in initial cost will be, you can put 5% over here, because we're saying it's going to be 5% increase over here. So you put just 5%, and we increase. So this will all require this to have a percentage. So allow me to do this, to do the following, to put this as percentage over here, comma format here, that. So don't worry about this. These are just the marks that are being allocated towards the entire question. So you can see it's 30 marks over here. So with the permission, then I can just do away with that. Or rather, I can just put them beside the questions over there. However, we can just do away with them for now. So with 5% increase, we just come over here, plus that value times a factor of 1 plus, we're increasing it by 5%. That's what it gives us, 42 million. With 42 million, we are saying the residual value remains as the way it is over here. Because we're saying that the residual value will remain as 2.5 million all through, whether there is going to be an adverse effect or so on and so forth like that. So here is 2.2 million like that. We proceed on, and even the number of units, this will be the same. The annual unit sales will be the same, 30,000. Here we are saying it's going to be 1100 like that. So I can just copy these values as the way they are towards the right there, with your permission. Because we are saying that the initial cost is the one that is only increasing. So here, just a copy, paste special values. And let's say okay, that. So if that's the case, what happens when we have a decrease in unit sales? 5% decrease in unit sales, because we're saying from the question right here that carry out a sensitivity analysis for the NPV assuming adverse variance of 5% for all the inputs except the project life and weighted average cost of capital there. So we are saying that now we want to put adverse effects over here. So we are going to have negative 5% like that. You can see it's even indicated to us over here. So here we are saying is going to come back to this, because we're saying we increased it from this to this based on the 5%, but now it's going to come down. And so I'll increase now each of these items moving towards the right there. The annual unit sales, the selling price, the variable cost, and so on and so forth. So that now right down over here we can now do the workings effectively. So you can say plus that value times 1 plus it should be because you're decreasing this value over here, 1 no so I think this is the formula, it's plus that value. We're decreasing it by 5%, so it should be delete plus this value, and then we're multiplying it by, open the brackets, 1, decreasing it means, so it's going to be, we're subtracting it from 0.05, so 1 minus 0.05, that. It shouldn't give us 1 minus 0. We took about 5% adverse effect, because we're saying from here, if we increase this one by 5%, so then decreasing it should be able to give us it should be able to give us take us back to where we actually were before, were there. So it should be just 40 million, that. And with 40 million, then we are saying that we can move ahead and say that variable cost is going to now also selling price in the variable cost is going to decrease over here. So we put negative 5% in terms of selling price, sorry. So negative 5%. So we put that, and it remains the same. Over here I'll explain that. If you're talking about the variable cost itself, also, it also remains the same like that. So it's going to remain including the residual value like that. But what we're saying is that here we will need then to put 5%, because we're saying it's 5% variable cost, 5%, then negative 5%. Because it's positive there. So we are saying what? That in terms of the initial cost, if it's going to increase, it's going to increase by 5%. If the unit sales decrease by 5%, then it's from this increase, it's supposed to decrease to 40 million back again. Then what about the residual value? The residual value should remain the same, with the exception of the very final residual value down over here. So it should remain the same here. So we just maintain it like so, up to there. But you're saying that the very final one over here is going to, this residual value is going to be plus that value times, open the brackets, 1 plus should be that value there. The residual value represents an inflow of money when you sell the asset. So we are saying that at this point over here, the residual value, a 5% decrease in residual value will cause it to be over there. That. So that's what we have. We proceed on to discuss the next item. Talk about the annual unit sales. The annual unit sales will affect what? Will affect this component right over here, this column over here, the annual unit sales. So here we are saying it's going to decrease, so plus that one times, open the brackets, 1 plus that 5%, negative 5%, 28,500. But the rest remain the way they are. These other values remain the way they are. So 30,000. So plus sorry, pardon me for that. undo, so it should remain 30,000. That should remain the same. Control R. It's only the unit sales. Why? Because you're saying that the unit sales are the ones which are being affected. The sales, we're dealing with unit sales. So this annual unit sales component should actually change. Next item is the selling price per unit. So what would change? So selling price per unit, this is what is going to change. That part there is going to change. Pardon me. That one is the one that's going to change. So here we are saying it remains at 1100. So here we are saying it's just going to be that, because it has already changed. This one remains the same, but the selling price changes based on that component there. So we are saying the selling price is going to be plus that one times, open the brackets, 1 plus selling price, comes to 1045, but the rest remain the way they are. How about the variable cost per unit? Variable cost per unit remains the same with the exception of the variable cost component. So here we expect it to remain the same. So we drag it up to there. But that value times, open the brackets, 1 plus the variable cost is increasing. 525, then the others remain the way they are. The fixed cost per year. The fixed cost per year, we are saying is going to be 5 million with the exception of the fixed cost component. Or just put it like so, up to there, Control R. So this one is just going to change plus that value times, open the brackets, 1 plus that value, and we enter. Then we remain with enter. We will have it like that. How about the project years? The project years remain the same. We've been told it's 5 years, so it goes without saying that it's going to remain 5 years. Just leave it like that. And with that, now those are the inputs that we've worked out. We now want to proceed to work out the solution. So the unit sales, we start by identifying the unit sales over here. Unit sales, over here we have, and of course here we have the base case given to us there. This one should be slightly above here because we do not fill in. So base case. That. Then here we are saying we're going to now put in the figures. The unit sales, 30,000. So we have them there. And then we copy these components towards the right here. Copy. Towards just the right here. base, just the same way. Then we have the initial cost is going to be how much? We're just going to copy and pick it from there. So the initial cost in terms of the unit sales is just going to be the same. You can see that because we're talking about the initial cost here. So when you're talking about the initial cost, we're just going to copy it like that. So enter. So the initial cost, we just pick it over there, just from above over here, because the initial cost is going to be an increase. So then the annual unit sold. So we just then autofill, Control R, with the exception of this one where we're saying the annual unit sales changes over here. Remember how we did it over here? Is what we're saying actually changes there. The next component is the selling price. Selling price. So we move like so. Selling price. Price. And the selling price or SP is given as plus that value. Enter it like that. Remember where it changes. It changes at the point where we have the selling price component there. So if it picks from above there, so just put it like so. You can see the selling price changes at that point here. Next component, next item is the total sales. Total sales. And you're saying the total sales is going to be given as we multiply you're just going to pick the values here given to us over here. Total sales plus from the question, just to clarify over here. One second. I get it. It's just going to be this value of here, selling price, times that value. That's what we're getting. Sorry. And once we have that, we proceed on to identify the next component there. And with that, we're saying we'll just be able to just pick the values, dragging them over here. Sorry, I was just having a bit of a small hitch. Sorry for that. So Control R. And you can see what happens there. We just pick the selling price and then we multiply with the unit sales. So what happens then now with the next component? So those are total sales. Once we have the total sales, we pick the variable cost per unit. Variable cost per unit. Sorry. Per unit. And the variable cost per unit given to us there is just going to be 500. You can clearly see it, it's just given to us over here, 500. So we just pick it. Remember, we're just picking the values the way they are over in the base case. Enter. And you remember the variable cost component changed at this point. Remember, it changed at this point here where the variable cost was actually increasing at 5%. So it changed to 525. So we just move towards the right and then Control R. How about the total variable cost? So here, with the permission, I'll just move this a bit towards the right. For here, I can say variable cost, total variable cost. Total variable cost. And the total variable cost will be given as variable cost in terms of shillings times the units. Put towards the right, Control R, and it picks. Once we have the total variable cost, we can be able to pick now the sales in terms of the variable costs, the sales variable costs, so sales. Variable cost. Sales variable cost. And we can see that it is just going to be the total sales and then we add the total variable cost. That's what we're going to do. So it's going to be the sales, which is there. Then we add that value. But there's one thing. The variable cost is a cost. Please note. So what we're supposed to do is that we're supposed to put this in form of a negative sign there. So apologies for that. Put a negative. Put it like that. Then I move it towards the right there. So that now we can be able to indicate or be to show that it is actually indeed a cost. And so you can see the sales variable cost actually changes there. So now what is left is for me now to just drag it like so. Please note one thing, that the unit sales were given to us there. The selling price was also given to us there. The total sales is just the unit selling price times the unit sales. The variable cost per unit, we had already computed it right above over here, and we say that this variable cost component over here is going to change by an increase of 5% increase variable cost. The sales variable cost right over here is just given to us as the total sales minus variable cost. So the sales less variable cost gives us this value here. How about the fixed costs? The fixed cost is given to us there as follows. 5 million. It's right here. So we enter, and because we're saying it's a cost itself, so let's put a negative sign there to show that it's a cost. Then we move towards the right like that. Remember, the component of fixed cost over here changed, 5,250,000. So we're putting it a negative over here just to indicate that it's a cost. And with that, we can be able to then identify the cash flows. Cash flows. So the cash flows we have over here are just going to be 18 million, and then we subtract 5 million. Or we add. Why I'm adding is because we need to, is because we're going to subtract. Please note. So we're going to add. If I subtract, it's going to be 18 minus minus, which comes to plus. So I should be able to just add it right there. So get 13,000. 13 million, pardon me. So 13 million, Control R, move towards the right. And those are the cash flows. But remember one thing, that there was a residual value over here that we didn't factor in, so we just put it in there. So the residual value year 5, so you can put it year 5, is a cash inflow. So how much? We pick those residual values from up above here, please. There. Then, because there's a change in residual value over here of 2.375, we need to factor that in. So Control R, but we do not subtract it. It's a cash inflow. So then we are going to, or we'll need then to get the present value interest factor. So down over here we'll have PVIF, present value interest factor, year 1, times cash flow. Times cash flow. Which cash flow? These ones here. So we'll do the same, PVIF year 2 times cash flow up to year 5. So year 1, year 2, so I'll just change this, it's going to be easier to change that. Year 3, year 4, then year 5. Cash flow there. And how do we get the present value interest factor? We're just getting the present value interest factor. Could put the interest rate right above over here. So interest rate, it's at 12%, all through 12%. So here we put that, and we 12%. So it's going to be plus the cash flow and then we are discounting it against open the brackets 1 plus that value, close the brackets, power 1 times, not times the cash flow, it's already been multiplied like that, so we enter. So once we have that, we shift Control R, that is year 1. Notice that I've done over here, you can see even the formula is power 1. So here I'll do power 2, power 3, power 4, and so on and so forth like that. So because I want the cash flow, so it's going to be plus that value over 1 plus that one, power 2, that. Then you do the same thing. One plus R power 3 that. So here is going to be this power 3. Yes, power 3. So power 4, sorry, I was just having some trouble with the mouse, sorry. So plus the cash flow over, open the brackets, 1 plus power 4, that, then finally we have power 5, but we will also need to work out the residual value right here. So the residual value, then the cash flow is going to be plus that value over 1 plus power 5. Enter. So Control R. Then we have what is called the residual value. Residual value. So you can see PVIF, value interest factor, year 5, times cash flow. That's what you do. So this is residual value. I should change this to enter, just to do that. And we're saying that the residual value was what value? Residual value was that one over 1 plus that value, power 5. Please note it's power 5 because there's a cash inflow that is coming in at the end of period 5. Just to confirm that it's okay. Yes, that's okay. So from there, we get the total PV. And I can just be able to indicate it using a bottom border, thick border, the bottom, thick border at the bottom there. You can see that we're getting the total present value. Present values is going to be those ones there, like that, up to there. Then I just drag it towards the right, Control R, it gets the total, and I bold that, Control B, as well as this one I Control B, like that, to show that that's the total present values. But remember, part A is requiring us to get the net present value. You can see here, compute the base net present value. So we need to deduct the initial cash outlays. So initial cost, we're saying plus, should I say plus or should I say minus? So say minus that value. The initial cost is there. So 40 million. Remember, the initial cost over here will change. This value here will change based on whatever we calculated over here. You can see it's 42 million. So we'll just change Control R, that, we get the NPV. Put it, Control B, then you put a top and bottom border. plus so then it may not be very clear, so I pick that thick border there, and then I put also this other border here with your permission. It's just presentation, good for presentation, characteristics of good financial models there. So with that then, we have the scenarios. Part B, carry out a sensitivity analysis for NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital there. So the base case we'll have, so part B, I can do it just down over here. So the base, we just almost like sort of copying this. Down over here. Then we have the NPVs down here, because we have the NPVs given to us over here, and net present values. NPV. NPVs. So just pick those ones. Then once you pick one, then you just drag it. With that, we can then just, now we've done that, carry out a sensitivity analysis, we've already done the sensitivity analysis, prepare an appropriate chart to indicate the different NPVs. So part A was to compute the base case NPV. We have already done that. The base case NPV is this. Then from there, we are told part B to carry out a sensitivity analysis of NPV, assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Adverse effect. So the initial cost, the initial cost was given to us over here as 40 million. So we've done an adverse, the opposite, the adverse, by increasing it of, or rather, by increasing it by 5%. So we've increased it by 5%. Here we've reduced the unit sales by 5%. The selling price we've reduced by 5%. So we're trying to answer part B, carrying out a sensitivity analysis assuming adverse variance of 5% for all inputs except project life weighted average cost of capital. Yeah. So we cannot have an adverse effect for the initial cost. You cannot, unless the cost is an adverse effect, means that the initial cost increases in value. That's what we mean. It cannot reduce. If the initial cost reduces, it means it's an advantage to us because we are spending less. You get the point? So the unit sales is now when you're getting a negative value over here. The unit sales decrease. The selling price also decreases here. The variable cost, because it's a cost. The only way a cost can be an adverse effect is if it increases. That's what you're saying. A fixed cost is, because it's a cost, if it increases is when it becomes an adverse effect. For residual value, becomes an effect when the value actually decreases. And that's why we are putting these values differently there. I hope that point is driven home. So with that, then I'll just go to part C here. So we've done a sensitivity analysis for the adverse effects of initial cost, selling price, fixed cost, variable cost, and residual value. And then we are told to prepare an appropriate chart to indicate the different NPVs, each scenario in B above. So what we'll do, we just go towards the right here. Towards the right. And we come and we move on to insert. Once you go to insert, we can come to recommended charts. Click on recommended charts, and you can see whichever chart pleases you, you can be able to recite it, so long as it yields whatever we actually need. So this one, maybe perhaps select this value here, this one. You say, okay. So the different NPVs that, or the different sets of, or the adverse effects of those values, base case, are actually indicated to us over here. And this means that at the base case, we are actually over there. The initial cost sensitivity plus 5%, because it's a cost. Any cost should be, an adverse effect should actually increase or get a positive value. But any positive value or selling price, or what we are selling, should actually be indicated by a negative sign if it is going to be an adverse effect. So these are the NPVs based on the initial cost, the annual sales, selling price, the variable cost, and the fixed cost, as well as the residual value. So this, ladies and gentlemen, brings us to the end of question 22, business and data analytics. We hope that you have enjoyed being with Manifested Publishers. Thank you, and God bless you.
Greetings and welcome to the lesson. The subject is financial management. August 2023, question 2. I read part A, Roman 1. Distinguish between temporary working capital and permanent working capital in relation to working capital management. Distinguish between temporary working capital and permanent working capital. Now, permanent working capital is the minimum amount of working capital that is required to maintain a company's day-to-day operations. It is the minimum amount of working capital required to maintain a company's day-to-day operations. And it represents the core level of current assets, the core level of current assets, that is the inventory, the accounts receivables or debtors, and cash. So permanent working capital represents the inventory that is needed, the accounts receivable needed, and the cash that is needed to support the ongoing business activities. And this permanent working capital relatively remains stable over time, as it is necessary. It is necessary. This is the capital that is necessary to meet the basic operations of an organization, like paying salaries, paying utilities, paying suppliers, and even buying stock. You understand? That is the permanent working capital. Then the temporary working capital is the additional working capital that is required to meet fluctuations in business activity. Now, fluctuations may be as a result of unusual demand. If you are running business, you may have that big order that is not anticipated. All right? In business, there are times when a business may experience, for example, peak season. During that peak season, the company may be required to get additional money to fund the inventories to buy stock, okay, to buy stock for sales and so on. So temporary working capital is the additional working capital that is required to meet such fluctuations in business. I've given an example of seasonal demand. We may have examples like special projects or unexpected expenses. A company may need to pay expenses that were not budgeted for. So that forms part of the temporary working capital. You understand? And that may include examples like additional cash that is required to cover large orders and so on. So candidates were to just required to distinguish to earn the 2 marks. You can distinguish by define temporary working capital and permanent working capital. And Roman 1 is related to Roman 2, which reads that the monthly working capital requirement for Mbuni Limited are given as follows. So you have the total working capital requirement from the month of January to the month of December. Below that table, we read that the short-term cost of financing working capital is 15% per annum, whereas the long-term financing cost is 20% per annum. The firm adopts an aggressive policy in financing its working capital needs. 80% of the firm's permanent working capital are financed using short-term funds, and the balance is financed using long-term funds. Required: determine the total cost of financing the working capital needs of the firm. Determine the total cost of financing the working capital needs. You can see from this question, there are 2 types of working capital: the permanent working capital and the short-term cost of financing. So we have the seasonal and the permanent. Required: determine the total cost of financing the working capital needs. Total cost of financing the capital needs. This is Roman 1, 2. What is the question? Determine the total cost of financing the working capital needs. There are 2 categories of working capital. That is short-term and long-term. Short-term and long-term. That is the permanent working capital and the temporary or seasonal working capital. So candidates are to calculate the total cost of financing. Total cost of financing. Do you understand? Total cost of financing is equal to, candidates, anytime you are to answer such a question or any other question, first of all, put down the formula. Then it is the formula that will guide you on how you proceed. So we have here total cost of financing. So the total cost of financing will be the cost of permanent working capital, cost of permanent working capital plus cost of seasonal working capital. These 2 will give us the total cost of financing. Do you understand? Yes? Yeah. So this is the formula. Total cost of financing working capital needs to be equal to the cost of permanent working capital plus cost of working capital. And from the question, we read that the monthly working capital of Mbuni Limited is given as follows. We have the total working capital requirements, January to December. Then the last paragraph we read that the firm adopts an aggressive policy in financing its working capital needs. 80% of the firm's permanent working capital are financed using short-term, and the balance is financed using long-term. Then we also read that the short-term cost of financing working capital is 16%, whereas the long-term financing cost is 20%. So let's have a working. There is a month, January, February, March, April, May, June, July, August, September, October, November, and December. Then we have the total working capital. Total working capital in thousands. January 3,000, 2,500, 2,000. April 1,500, 1,500, 1,700, 1,800, 2,800, 3,200, 3,500, 3,600, 3,800. That is the total working capital. So you need to put down the total working capital. The total working capital. Total working capital. Then out of the total working capital, candidates, you can see that the permanent working capital, you recall we said that the permanent working capital, that is permanent working capital, from this information that is given, we can tell the permanent working capital. I began by defining the permanent working capital as the minimum amount of working capital required to maintain a company's day-to-day operations. So out of the total working capital that is shown for each month, which one is the minimum amount of working capital? Minimum. The minimum amount of working capital will be the permanent working capital. Is that clear? Can someone try that? Israel says 1,500. 1,500. 1,500. That is correct. 1,500 will be the permanent. 1,500. 1,500. 1,500. That is the permanent working capital. 1.5 million. Is that clear? Is that clear to everyone? Or someone has a question on that? There's no question. Now, if the month of January, the total working capital is 3 million, and the minimum amount of working capital required is 1.5 million, then what will be the seasonal working capital? Seasonal working capital. What will be the seasonal working capital? Seasonal working capital. Vincent says 1.5, 1.5, 1.5, 1.5, 1.5. Yes, it should be 1.5. February, Perry says 1,000. March, 500. April, dash. June, 200. July, 300. August, Mori says 1.3. 1.3. September 1.7. October, Mori says 2 million. October, 2 million. November 2.1. Mori says 2.1. Is that true? Yes, it's 2.1. December, 2.3. 2.3. So that is the seasonal working capital. Seasonal working capital. So get the totals. What is the total permanent working capital for the company? Total seasonal working capital. Emmanuel says, sorry, I don't understand how calculating. To calculate the seasonal working capital, if this is A, B, C, this C will be equal to A minus B. Total working capital, Abraham, we are given from the question. The minimum from these figures is 1,500. The seasonal is excess. We are subtracting the permanent working capital from the total working capital to get the seasonal working capital. So this seasonal working capital is equal to total working capital minus permanent working capital. That is how we are getting it. Right? So permanent total, someone says 18 million. Permanent total, 18 million. Total seasonal working capital, seasonal 12.9, 12.9 million. So that is the total, and that's all we need. Candidates, we are calculating the total cost of financing working capital, which is equal to the cost of working capital plus cost of seasonal, cost of permanent working capital plus cost of seasonal working capital. And from the question we have the rate, we read that the short-term cost of financing working capital the short-term cost of financing working capital is 15%, whereas the long-term financing working capital is 20%. So that will help us calculate the cost in shillings. These are costs in rates, 15% and 20%. All right. So the permanent working capital is the short-term borrowing. It is the short-term borrowing. And candidates, we've read that the firm adopts an aggressive policy in financing its working capital needs. 80% of the firm's permanent working capital are financed using short-term funds. That's a very important information. Seasonal working capital. So the seasonal working capital will be equal to the 15% times 12.9 million. 12.9 million. That is the cost. That will be the cost. How much is it? Seasonal working capital? 1935. So this is 1935. That is the cost. How about permanent working capital? Permanent working capital, we read that 80% of the firm's permanent working capital are financed using short-term. And the balance is financed using long-term funds. So what will be the cost of permanent working capital? Give it a try. What will be the cost of permanent working capital? Mani says 2160. Now the permanent working capital, the cost 20% of 18 plus seasonal. Now permanent working capital is in two parts. It's in two parts. This one is in two parts. We've read that 80% of the firm's permanent working capital are financed using short-term funds. So 80% of means times 80% of the firm's permanent working capital. What is the firm's permanent working capital? The firm's permanent working capital is 18 million. It's 18 million. So 80% of this 18 million is financed 80% of the firm's working capital are financed using short-term funds. So what is the rate for short-term funds? The short-term funding is 15%, so times 15%. So that will be the short-term. Now, if 80% of the permanent working capital is financed using the short-term, then how about the 20%, the remaining 18 million? We read that is financed, 80% of the firm's working capital are financed using short-term, and the balance is 20% of 18 million is financed using long-term funds, and the cost of long-term financing is 20%. So you need to get these two, then you get the total. That is how to calculate the permanent the cost of permanent working capital. Cost of permanent working capital. Is that what you did? What is the total? The total, Mani says 2160. Is it 2160, the first one? 2160? This one, 2160? Can you confirm? How about the 20%? Someone says 720. Then what is the total? The total? The total? These two will be equal to this 2880. That okay? No, it's 20. Yes, 2880. Is it 2880? So the cost of permanent working capital, 2880. The cost of seasonal working capital, 1935. So the total cost of financing will be equal to the cost of permanent working capital plus cost of seasonal working capital, which is equal to 2.880 plus. So the total is? The totals, Regina says 4815. So the total is 4815. That is the cost of financing. Someone says, I don't understand. Yes, I understand if you don't understand. If you don't understand, I understand. Because part A of the question is linked to part B. Part A, we read, distinguish between temporary working capital and permanent working capital. So if you do not know the difference between temporary working capital and permanent working capital, you may not understand the calculation. So maybe you do not understand, you may have come in after we had explained what is temporary working capital and permanent working capital. Now, first of all, that is DML. DML, working capital, means, before we get to the permanent working capital or seasonal working capital, working capital refers to investment in assets and current assets. Is just investment in current assets. All right, that is working capital. When you say working capital, we are referring to investment in current assets like the debtors, inventories, and so on. That is working capital. Working capital can be categorized into two: permanent working capital and seasonal working capital. Seasonal working capital may also be referred to as temporary working capital. Do you understand? Permanent working capital, we explained, is the minimum amount of working capital required to maintain a company's day-to-day operations. The minimum. The minimum. And if you look at the table here, we have the total working capital requirements from January to December. We have the amount for January, 3 million, February, 2.5 million, March, 2 million, April, 1.5. Now, out of all these capital requirements, working capital requirements, which one is the minimum? That minimum is 1.5, which now becomes the permanent working capital. That is the minimum amount of money that this company must maintain in order to continue paying the short-term liabilities in order to keep on paying the day-to-day expenses. Working capital is meant to meet the day-to-day expenses like salaries, rent, utilities, tea in the office. There's a time offices also used to buy newspapers, all right? Those day-to-day expenses require this permanent working capital, which is the minimum amount of money that is required to meet the day-to-day operations. So I've given examples. Then there is the temporary working capital. The temporary working capital, which we are referring to as the seasonal working capital. This is now the additional capital that is required over and above the minimum. A good example is in January. January's total working capital is 3 million. The minimum amount that is required for every month, the minimum amount that is required for every month is 1.5 million. Therefore, there is this additional working capital that was needed during the month of January. But for the month of April, the minimum amount that this company needs to meet its day-to-day operations is 1.5 million. Okay? In April is 1.5 million. Then that's the minimum, the total. So the company did not need to have any additional working capital. No additional money was required. Do you understand? So you need to first of all get that understanding that there are two categories of working capital, the permanent working capital and the seasonal working capital. We say that this seasonal or temporary working capital is the additional capital that is required. We gave examples like when the company is in its peak season, or when a company gets an abnormal order, unusual order, all right? The company may need to get money, additional money to meet that order. Large orders is an example. So, and permanent working capital comes at a cost. Seasonal working capital comes at a cost. And the costs are shown in the given in the question. We read that the short-term cost of financing working capital is 15%, and the long-term financing cost is 20%. So this question, we were provided with the total working capital. From this total working capital, we are able to tell the seasonal working capital by deducting the permanent working capital from the total working capital to get the seasonal working capital. Okay, for each month, then we calculated the total permanent working capital and the total seasonal working capital, and that is the working that we have here. Seasonal working capital is 15%. The cost is 15%. Okay, so to get the seasonal working capital, we applied 15% on the total seasonal working capital of 12.9 million, which gave us 1,935,000. For permanent working capital, this we are given information. We calculated based on the information provided. Okay? We see that the firm adopts an aggressive policy in financing its working capital needs. We read that 80% of the firm's permanent working capital, 80% of the firm's permanent working capital. The firm's permanent working capital is 18 million. So 80% of 18 million is financed. The cost is 15%. So we apply this 15% on 80% of 18 million to get 2,160,000. Then the remaining 20% of 18 million is the cost is 20%. So that's how we arrived at the permanent working capital of 2,880,000. So that was just 6 marks. Is that clear? Is that clear? for the month of October, add 0 to the 2. For the month of October, add 0. Yes, there's a 0 here. So let's move on. DML, I think it's now clear how we distributed the 80% and 20%. We just followed the information provided in the question. Part B of the question, I read, Fila Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. The second sentence, the machine costs 13,950,000. The firm will incur installation cost of 450,000 shillings. The machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. The overhaul will cost 1,125,000. After 6 years, the machine could be disposed of for 900,000 shillings. The company estimates that it will cost 2.1 million per year to operate the new machine. The current manual production method costs 5,250,000 per year. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. The company realizes a contribution margin of 45 shillings per unit. Additional information: number 1, the company applies straight line method of depreciation. Number 2, corporation tax rate is 30%. Number 3, Fila Limited requires 20% return on all investment. On all investment. That should be on all investment and not an all investment. Required using NPV, project evaluation method, advise Fila Limited on whether or not to purchase the machine. Now, questions on capital budgeting can be easy, but they can also be a bit tricky. Okay? And you cannot say you have mastered capital budgeting because the questions can be varied. Like this one has never been set this way before. The one you are going to sit may be totally different, even if you understand this one today. But it's important for you to get the concept. And I've always said, when you have such a question, step number 1, what are you supposed to do? The first thing to do. What should you do first? Step number 1. Yes, capital budgeting is not a joke. It is not a joke, Willis, because of the nature of the decisions that are made in capital budgeting. As a finance manager, you are required to help the company make such a decision. It's not a joke because money that is invested in a capital project is quite substantial and significant, and therefore there is no joke when you are dealing with such kinds of money. In working capital management, you are dealing with the day-to-day expenditure. This question, okay? Working capital, we are referring to paying of day-to-day expenses. But in capital budgeting, a decision that is made in capital budgeting, if you make a mistake, then that can lead to corporate failure. That's why even questions in exam are quite, but is be that as it may, I'm saying, when you have such a question in the exam, you can see the question is 12 marks. These are many marks. You need to try and score at least 10 or at least 6 marks out of this question. As much as the question may look technical, you can still score some marks. Now, when you have a question like this one, just like the other one, the first thing to do is to put down the formula using NPV. What's a formula? NPV. Formula, net present value. Net present value, you are just comparing two things. The money that comes in and the money that goes out. Then you get the net. Okay? So, this one is constant. The formula is constant. Net present value. It doesn't matter the level of complexity of the question. The formula still remains the same. So, NPV is equal to the summation of present values of cash inflows, cash inflows minus the present value of cash outflow. In capital budgeting, is just the initial investment. Initial investment. Present value of initial investment. Initial investment. So that's what you do first. Is that clear? Formula. Then it is from this formula, then you can be guided on what to do. From this formula, we know we just need two things. Present value of cash inflows, and a question may have one inflow or multiple inflows. So you will have to aggregate all the inflows. Then you subtract the initial investment from the inflows to get the net. I think that is quite easy. Are we clear up to that point? Are we clear? That is clear. We just need two things. Then we get the net to get the answer. Anything else that we are going to do is just under workings. Any calculation we are going to do, those are workings. You understand? So, what are the cash inflows? What are the cash inflows? Once you have the formula, then you can proceed. We identify the cash inflows from this question. We read the question that Fila Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. That sentence, there is no inflow, is it? No. Second sentence says the machine costs 13,950,000. That is not an inflow, that is an outflow. Then we read the firm will incur installation cost of 450,000 shillings. That is an outflow, it's not an inflow. The next sentence I read, the machine will have an economic life of 6 years but will require an overhaul at the end of the 4th year. Will require an overhaul, and the overhaul cost will be 1,125,000. That is an outflow. Then we read after 6 years, the machine could be disposed of for 900,000. Will be disposed. When you dispose a machine, is that an inflow or an outflow? Can you answer that question? When you dispose a machine, yes, that is an inflow. So the 900,000 shillings is an inflow. It will be part of this. That's why I put here summation. That is one of the items we need. So we have it 900,000 shillings. In financial management, what is the name we give to these 900,000? What is the name of these 900,000? Abraham says working capital. Is that true? Salvage value. Salvage value. Everyone is saying salvage value. Abraham says disposal value. What did the examiner call it? The machine could be disposed of 900,000. In technical terms, that is what is referred to as terminal cash flow. Terminal cash flow. So we are calculating cash inflows. So the first one is the terminal cash flow, which is the salvage value, as you are calling it, or scrap value, as you are calling it. But in technical terms, that is the terminal cash flow. Because in another question, this terminal cash flow may be used. You'll be told that the terminal cash flow is 900,000 shillings. Okay? So this is equal to 900,000. The next sentence reads that the company estimates that it will cost 2.1 million shillings per year to operate the new machine. It will cost 2.1 million shillings to operate the machine. The current manual production cost is 5.250 per annum. The current. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. Okay? Will allow the company to increase production capacity by 120,000 shillings per annum. The company realizes a contribution margin of 45 shillings per annum. That is where we also have cash flows. Contribution is a cash inflow. Okay? Is a cash inflow. So, candidates, one cash inflow is the 900,000. Then the second paragraph gives us other inflows. Other inflows. The question reads that the current manual production method costs 5,250,000 per annum. In addition to reducing annual operating costs, underline that one. In addition to reducing the annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. So, in addition to reducing annual operating costs. Now, that reduction in annual operating costs is an inflow. It is a saving. By acquiring this machine, the company is going to save. Okay, that saving is part of what we will need or use to calculate the what Omiti says annual operating cash flow, because it is annual operating cash flow. Okay, I want you to note that cash inflows can be in form of savings. It can be in form of, look at the next part of the sentence, the new machine. In addition to that, then the new machine will allow the company to increase production capacity by 120. So those are two inflows: the saving and the 120 units, because the 120 units is additional, will increase by over and above what the old machine is capable of producing. This new machine will produce excess by 120,000 units per annum. And you are given the company, that the company realizes a contribution margin of 45. Because that is the, if you understand that, candidate, then we can move. So we have the terminal cash flow. Then we have the saving. Then we have the contribution. This will give us the present value of cash flows. So it's important to get the understanding. Analyze the question. Put down the formula first, then check from the question, where do you get these inputs? So you've seen this will come from, first of all, the terminal cash flow. And by the way, terminal cash flow represents the net cash flow a project or investment is expected to generate at the end of its useful life. That's what we are referring to as terminal cash flow. What is expected to be raised from the project at the end. This is a machine that is bought now, then at the end of the 6 years, it will be sold. That salvage value, or what you are calling scrap value, is a terminal cash flow. So have you understood up to that point? Because it's important for you to first of all understand where are the cash flows coming from. Because the question ends at realizes a contribution margin of 45. That is all. We've finished analyzing the present value of, the cash flows. Can we proceed? So we can proceed to calculate the cash flows. The cash flows. Let me use the term that Omiti used, annual operating cash flow. The annual operating cash flow. Let's proceed. Let's put ink to paper. Workings. So we are first of all going to calculate the incremental net cash flows. Omiti said operating cash flows, but it's supposed to be incremental net cash flows, which will be equal to the incremental earnings before depreciation and tax, okay, times 1 minus T plus the incremental earnings before depreciation and tax. incremental depreciation tax shield. Underline incremental. Okay? Incremental. Why incremental? Let's take it again, the question. The company estimates that it will cost 2.1 million per year to operate the new machine. Okay? The current manual production method costs 5.250 per annum. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120 units per annum. Will allow the company to increase, okay, production capacity by 120 million. That is incremental. That there will be incremental cash flows. There will be incremental cash flows. I want you to note that the new machine will allow the company to increase production capacity by 120. Okay? So, we've seen that the cost of, let me put it down, the cost, we have the cost, the current cost, the current manual production cost method, okay? The current manual production cost, the current, let me use the words in the question, the current manual production cost is 5250. That is the current. Okay. Then we read that the company estimate that it will cost 2.1. It will cost 2.1 per annum to operate the new machine. So it's going to the new machine to operate the new machine. It will cost 2.1 million. So what is the difference? This difference is an annual saving. You understand? Currently, before, it is 5.2. But if this company buys this new machine, it will go down. This cost will go down. So what is the difference? What is the difference? Vincent says 3150. 3150. That is the annual cost saving. 3150. 3150. Correct. 3150. Now to this 3150, we are going to increase that to include that additional contribution. Additional contribution. Additional contribution, we've seen, will be 120 units. This is 120,000 units times the 45 shillings per unit. This is the contribution. We add it to that annual saving. 120,000 units times 45 shillings. How much? 5400. 5400. These are inflows. What is the total? Total. What will be the total? 8550. 8550. That 8550 is the annual benefit before tax. Annual benefit before tax, that one. That is the annual benefit before tax. Then what is the tax? Is it 30% of 8550? That is the tax. Apply the tax. How much is the tax? The tax 2565. 2565 is the tax. Remove the tax. That will be the benefit after tax. How much is it? 59 annual after tax benefit. 5985. This is the annual after tax benefit. That is the annual after tax benefit. Is that clear? So this is the annual after tax benefit. So I would like to understand this working among the three components of cash flows. Which working? The three components. We are calculating cash inflows. Abraham, we are calculating cash inflows. And we have seen that cash inflows are in two categories. One is the saving. This saving. If this new machine is bought, the cost of production will reduce by 3,150,000 annually. Okay. Another cash inflow is the contribution. This contribution. Because this is a new machine, this machine will produce 120,000 units more than what is being produced by the old machine. So the contribution is 45 shillings per unit. You multiply by the number of units to get this 5.4 million. Then the total annual benefit, which is equal to the saving in production costs and additional contribution. Because most questions candidates, you are always given just the contribution or the cash flows. But you need to understand this cash inflow can be in form of saving. It can be in form of saving. It's like these videos you bought, those of you bought videos at 4,500 shillings. If you are to go to a physical class, you would pay 10,000 shillings. So the difference is the saving. Okay, so it's like you've not spent the money, but you've saved. That saving, by making the decision to buy online videos, you saved money. Instead of paying 10, you are now paying 4. So the difference is a saving. So savings, when you are making the right decisions, you retain the money. So that is the money that you will retain. So that is it's like an inflow. Okay, so that is the total. Then we deduct the taxation. Then we have the annual after tax benefit. We remove the tax. And that is just one point. There is another technicality, candidates. This is not what we'll apply here. This is just a working because let me take you back to the first paragraph. the firm will incur that. Then the third sentence says, the machine will have an economic life of 6 years, but it will incur an overhaul cost at the end of the 4th year. The overhaul will cost it will cost 1,125,000. After 6 years, then it will be disposed of. Okay, it will be disposed of. So look at the board. Look at the board. The incremental cash flows, we've seen that is equal to the incremental annual tax benefit, because this is the incremental annual tax benefit, this one here, after removing the tax. This is what we have obtained. So to calculate the incremental net cash flows, which we need to discount here, we need the incremental after tax benefit, which we have calculated, but we also need the incremental depreciation tax shield. The depreciation tax shield. Okay? The depreciation tax shield. We need to add to this annual after tax benefit. We need to add, this is addition, we need to add the incremental depreciation tax shield. So this is just part of the working. We need to do the incremental depreciation tax shield. And you can see depreciation is in 2 parts. Depreciation in this question is in 2 parts. So to calculate the incremental depreciation tax shield, we need first of all to determine the depreciation. It is depreciation tax shield. And the candidates, to help you understand, depreciation tax shield is the tax savings that a company realizes from claiming depreciation as an expense on its tax return. Because by now you know that depreciation is a non-cash expense that represents the gradual reduction in the value of tangible assets. So when a company purchases a depreciable asset, it spreads the cost of the asset over its useful life as a depreciation expense, as we have seen in this question. We've been given the depreciation details on depreciation. So a company will spread the depreciation expense over its useful life. And the depreciation candidate's expense effectively reduces the company's tax. All right? Depreciation reduces the company's tax. Depreciation effectively reduces the company's tax liability by an amount equal to the depreciation expense multiplied by the tax rate. So depreciation tax shield is equal to the depreciation expense times the tax rate of 30%. So to calculate the depreciation tax shield, because we know the tax rate, we are required first of all to calculate the depreciation. Do you understand? That's the meaning of depreciation tax shield. And I know you are taxation students. You've covered taxation. Understand when I say that depreciation is a non-cash expense. Okay? It is a non-cash expense. Non-cash expense. So let's calculate depreciation, which we'll now use to determine the depreciation tax shield, which is a tax saving. Okay, depreciation. I'm aware at this point I lose some of you, but to find way you have to get lost. Okay, then you find your way. So you want to determine the depreciation. Question reads, the company is considering purchasing a new machine so as to improve its production process, which is currently being undertaken manually. The machine costs 13. This new machine will cost 13,950,000. The firm will incur installation cost of 450. The new machine will have an economic life of 6 years, all right, but will require an overhaul at the end of the 4th year. The overhaul will cost 1.125 million, okay, after 6 years, all right, after 6 years. So what is the depreciation? Annual depreciation. Now, if you are given the economic life, you are told that the machine, the firm will incur installation, and then the machine will have an economic life of 6 years. So that means that this company is using the straight line method of calculating depreciation, which is equal to cost minus salvage value over economic life. That is a straight line method. Straight line method. Okay. So the machine will cost 13,950,000. The firm will incur installation costs. So the cost will be the purchase price plus the installation cost. So that will be 13,950,000 plus 450. That is the cost. Okay, that we are going to depreciate. How much is it? 14.4. So this is 14.4 million minus the 900,000. We divide by 6. We divide by 6. That is the annual depreciation. This is 2250. Then look at the second last sentence of the first paragraph. We read that the machine will have an economic life of 6 years, but will require an overhaul at the end of the first year. The overhaul will cost 1.125 million. So candidates, that cost ought to be depreciated also. You understand? If you are doing financial reporting, what does that mean? This amount has to be capitalized, just the same way we capitalize the 450. The installation cost is a cost that was capitalized. Okay? This overhaul cost should also be capitalized. The overhaul cost has to be capitalized The same way we have capitalized the installation cost. And that is what we refer to as amortization. That cost amortization. We need to amortize. Okay? So the amortization will be from which year to each year. We read that the machine will have an economic life of 6 years, but will require an overhaul or at the end of the 4th year. At the end of the 4th year, that means that the machine will be capitalized at the beginning of the 5th year, then the 6th year. So amortization cost is going to be 1,125,000 divided by 2. That will be the amortization cost per year. How much is it? How much is it? Yes, 2 years. So per year we divide by 2. Per year we divide by 2. 562.5. 562,500 per annum. Do you understand? The cost is first of all capitalized, then you depreciate it. Do you understand? Someone is asking, why not 4? There are 6 years. 1, 2, 3, 4, 5, 6. Someone is asking, why not 4? It's not 4 because the machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. At the end of the 4th year is the beginning of the 5th year. So there are 2 years. This amortization will only apply for the 2 years. This cost will be incurred at the end of the 4th year. So that's why we are dividing by 2. 1, 2, 2 years. That is I'm answering DML's question. We are dividing by 2 because this cost was incurred at the end of the 4th year. This machine's economic life is 6 years. It worked very well in year 1. It worked very well in year 2. It works very well in year 3. It works very well in year 4 until the end of year 4. So they needed to boost this machine so that to overhaul it. Maybe there is a gadget that needed to be replaced. When you are running a machine, if you have a car, you know what I'm talking about. If you buy a new car today, you may not incur any expenses for 1 year, 2 years. Some cars is even 5 years without changing anything. But as the car is being used, the car depreciates some spares, or some, not spares, but some items, the shocks wear out, so they may need to be replaced. You overhaul it, okay? The wheels may need to be changed. So if you have a machine, that's what happened. And as I said, when you are looking at these questions, candidates have a practical mind, because this is a practical thing. Here we are talking about is practical application of is practical financial management techniques. The NPV is a practical technique. So here this machine has, when it was bought, it functioned very well year 1. Year 2 it functioned, it's meant to function very well. Year 3 to function very well. In year 4, this machine is getting tired. And the same thing even happens to you. When you are young, you run. As years go by, you find that the speed reduces. As you age, sometimes you are not able to walk. All right? There are people who bend even their back. There comes a time you cannot walk. machines also, they have economic life. You see, life, the life as the machine is being used. So at the end of the 4th year, the company had to spend 1,125,000 to overhaul it. That means that the machine was in business just for 2 years, because at the end of year 4, it's the beginning of year 5. So it was depreciated in the 5th year and the 6th year, 2 years. You understand? And the same way we added 450, the installation cost, it was capitalized. Okay? And there is even a standard. If you are a financial reporting student, you should be able to tell me under which standard do we capitalize such costs. Okay? If you are an auditing student, as an auditor, you are also required to know that standard, so that when you are auditing the records of a company that has made such an expenditure, you need to check if this expenditure was capitalized. Okay, if it was capitalized. So I've answered the question on 2 years. Can I have another question? So that is, where are we? We are here. We are here. So why are we calculating depreciation? Why are we calculating depreciation? Let's get back. We digressed a bit. Why are we calculating depreciation? We are calculating depreciation so that we can apply the tax rate to get the incremental tax shield, which will now help us to add to the annual after-tax benefit to give us the incremental net cash flows, which will now get the present value, then deduct the initial investment to get the NPV, then we can advise the company. Because after understanding the depreciation part, this is just part of a working. We've calculated the incremental after-tax benefit. We need to add the incremental depreciation tax shield, okay, which is a tax saving. Okay, we say that depreciation tax shield is a tax saving that a company realizes from claiming depreciation as an expense on its tax return. Is that clear? Is that clear? Someone said that one is tricky, which now is not tricky. Can we now proceed? So we need to calculate the depreciation tax shield. Depreciation tax shield. Depreciation tax shield. So from year 1 to year 4, depreciation tax shield will be different. From year 5 to year 6 per year. Okay, depreciation tax shield year 1 to year 4 will be the tax, because DTS, the tax saving, is equal to the tax rate times the depreciation, 2250. That is per year. Then year 5 to year 6, the depreciation is, tax shield will be 30% times 562,500. So can you give me the depreciation tax shield from year 1 to year 2? And this should be per annum. 2,250,000 per annum. What will be the DTS per annum? The DTS per annum. So we have depreciation tax shield year 1 to year 4. Then we have year 5 to year 6. Please pay attention. Pay attention. Or let me analyze. Let me find a way of simplifying it. Let me find a way of simplifying depreciation before the tax shield. This is still okay, but let me present this differently so that someone does not say depreciation is also, the depreciation tax shield is also tricky. So that you may not say it is tricky, let us analyze depreciation. Let us analyze depreciation before we get to the tax shield. So we have depreciation year 1 to year 4. Then we have depreciation, this amortization, year 5 to year 6. Depreciation is in 2 categories. Depreciation from year 1 to year 4. Okay, that is depreciation per annum. Per annum from year 1 to year 4 is 2250. Okay, per annum. This is depreciation per annum. The other category is year 5 to year 6. We still have 2250. All right. Then we have annual amortization. Annual amortization. There is no amortization between year 1 and year 4, but we have this amortization per annum of 562,500. So this will be the total. You have that total and we have that total. So this is 2250. Then give me this total. 2250 plus 562,500. 2812. 2812. 28 12. 2812. Abraham says 2418. 28 12 500. 28 12 500. So this was yet another complication, candidates. The depreciation per annum from year 1 to year 4, we calculated it here. This is the depreciation per annum. Year 1 to year 4 per annum, 2,250,000. Depreciation per annum for the 2 years is in 2 parts. This original machine, which has a salvage value at the end of 6 years, so this one is maintained at that. Then we add this amortized cost, the amortized cost. Okay, the cost that we amortize, 562,500. overhaul cost is also capitalized and depreciated or amortized. It is amortized. So between year 5 and year 6, these 2 years, the annual depreciation is not 2,250,000, but 2,250,000 plus 562,500. Is that clear? Is that clear? So that the depreciation tax shield per annum, year 1 to year 4, will be 30% times 2250, and for the other 2 years, this is per annum. What we get here is per annum. For the 2 years, it will be 30% times 2812.5, again per annum. That is the DTS per annum. DTS per annum. How much? Yes, it is clear. Abraham says year 5 to 6, 873. The depreciation tax shield year 1 to 4. This is 843. 843. 843. 843. Okay. How about year 1 to year 4? 843, 750. Per annum, year 1 to year 4. Year 1 to year 4. 675. 675. So this is 675. That is the depreciation tax shield. Why are we calculating the depreciation tax shield? So that we can add it to the incremental annual after tax benefit to get the incremental net cash flows. All right. So is that clear up to that point? So we need to add these two. Incremental cash flows. Incremental cash flows. So we have year 1 to year 4. Year 1 to year 4. The annual after tax benefit. Annual. This one. After tax benefit. From year 1 to year 4 is 59,85,000. The same here, 59,85,000. Okay, that is the annual per annum. Per annum. Then we add the DTS, incremental DTS. We add this annual incremental DTS, which you've calculated here. From year 1 to year 4 is this one, 675. We are adding candidates, this and that, to get the incremental net cash flows. So year 5 to year 6, the DTS is 843,750. So we're going to add these two. That will give us the incremental net cash flows. The incremental net cash flows. The incremental net cash flows. So the total, give me this total. The incremental net cash flows, year 1 to year 4. Incremental net cash flows, year 1 to year 4. Israel says 1,666. 666. Is it 666? 666. 66600. Yeah, 66000. Year 5 to year 6. What is the total incremental cash flow? 620, 68, 28, 68, 28, 68, 20, 68, 28, 750. 750. These are very important working. That is a very important working. So at this point, I need another paper. In an exam, you call for another booklet. Okay, if you are in an exam, see you have done everything. So you ask for another booklet so that you can continue. I don't need this. Yes, I don't need this. I don't need this. I don't need this. Another booklet. All these workings, candidates, was to help us get the cash flows. These are cash flows. These are the cash flows. And these cash flows are future values, which we now have to discount. We're now going to discount these values so that we get the present value, the summation of the present value of the cash inflows. And remember, we've not even done that again. After that, we'll calculate the initial. So do you understand how we are moving? We are now want to discount these cash flows. Because you see, these are values at the end of year 1, at the end of year 2, year 3. These are in future terms. So we need to discount. Then we deduct the initial investment to get the NPV. Then we will advise this company. Are we on the same page? We need to get the present values. Present values. We are now going to get the present values of the cash inflows. So begin with the year. We'll have a column for year. And you see we have year 1 to year 4 cash flows. Year 1 to year 4 cash flows. So we have year 1 to year 4 cash flows. Then we have year 5 to year 6 cash flows. Do you see the cash flows? Year 1 to year 4 cash flows. Year 5 to year 6 cash flows. They are different. The cash flows that will be received from year 1 to year 4 is different from the cash flow that will be received from year 5 to year 6. So we have to make it clear. Then we recall the terminal. There is also the terminal cash flow. The terminal cash flow, the 900,000. We also need to discount it. So these are cash flows. Year 1 to year 4, 666. 666. Year 5 to year 6, that is 6828. 6828, 750. Terminal cash flows, 900,000. Then we are going to have the present value annuity factor. Now, these cash flows are also in two categories. These are annuities because they are uniform throughout year 1 to year 4. It's the same. That's an annuity, an inflow. Every year from year 1 to year 4, the company will receive 6,650,000. It is an annuity. So we are going to discount this one. Let me have it here to help you understand. This first one is going to be the present value annuity factor. We know the discounting rate is 20% from the question. The last additional information, Fila Limited requires 20% return on all investment. So the discounting rate is 20%. 4 years. So you're going to multiply this one, the present value annuity factor, 20%, 4 years. What is the factor? Give me the factor. 2.5887. 2.5887. The other one is 6 years. Only change this to 6. Give me the factor. To get the present value annuity factor at this point, year 5 to year 6, the factor will be present value annuity factor 20%, 6 years, minus present value annuity factor 20%, 4 years. So you are going to calculate two factors. The difference is what we are going to have here. So if you got 3.3255, so it's going to be 3.3255 minus 22, 2.5887. That will be equal to 0 point something. 0.73. 0.7368. 0.7368. I know we'll lose a few people there. Those who did not attend our classes, you will have a question here. Why not 3.3255? You'll have questions. Let's move on. The factor for the terminal cash flow. Give me the one for 900. This one. Someone says 0.7368. If you got that one, this is wrong. If this is what you are getting, then that is not correct. Ask me why. This one is not correct. Yes, 0.3349. You saw your mistake. 0.3349. 0.3349. 0.3349. 0.3349. Then apply the factor to the cash flows. Give me the present values. Then give me that total. Present value 1 to year 4. Multiply that by that right there. That by that right here. Right by that right here. Get me the total. How did you get 0.3349? How did you get 0.3349? How did Emma get 0.3349? 0.3349, Emma, is not an annuity. It is not an annuity. It is a lump sum. This money will be received at the end of the economic life. It is a terminal cash flow. It is a terminal cash flow. And we say the terminal cash flow is the amount of money that the company expects to receive at the end of the life of the asset. So it is a lump sum. It is not an annuity. And the present value interest factors of annuities, the formula is different. This is the formula 1/1 plus R raised to N. That is how you get 0.3349, where R is 20%, N is 6 years. Is that clear, Emma? Correct. Total 22,573. Someone is getting 22,573. 22,573. 575. 575. Third is 30, 14, 10. 30, 14, 10. Second, 50, 31. 50, 31. 50, 31. 423. 423. The first one, 17, 240. 17, 240. 17, 247. 742. That's the total. Make sure you get the figures right. Make sure you get the figures right. That is the figures right. Okay. So that is the total present value of cash flows. This is the total present value of cash inflows. All right. Then we deduct the initial cash outlay. Initial cash outlay. Initial cost. Initial investment. What is the initial investment? Look at the question. The machine costs 13,950. That is the purchase price is 13,950. We add the installation cost of 450. What is the total? Purchase price plus installation cost. Purchase price plus installation cost. 14,400. 14,400. To this 14,400, we add the present value of overhaul cost. We have to add the present value of the overhaul cost, which we saw will happen at the end of the 4th year. We are calculating the initial investment, which you have seen is equal to the cost of the machine plus installation cost plus the present value of overhaul. Present value of overhaul cost. The overhaul cost is 1125. So the present value will be 1125 times 1/4. 1 plus R. Our R is 20%. It will be 1.2 raised to 4. So what is the present value? Kenneth says 542, 587. 542, 542, 587.5. 587.5. So what is the total? Purchase price plus installation cost plus the present value of overhaul cost will give us the initial investment. Kenneth says 14,942. 14,942. 14,942. 14,942. 587. 14,982, 587. 587.5. Give me the net. What is the net present value? Mary says 76. Money 7630. 7630. 7630. 7630. 7630. 987. 987.5. That is a positive NPV. That is a positive NPV. Is everyone getting the same answer? 76. Israel is getting 7630. Yeah, 7630. 7630. So what is the advice? Because you are to advise using the NPV project evaluation method. Advise filler on whether or not to purchase the machine. Purchase or not purchase? Advice. Purchase the machine because the NPV is positive. Purchase the machine because the NPV is positive. NPV is positive. Formula. Advice. Okay. How many marks? 12 marks. So the reason why we've taken too long is because I'm taking time to help you understand. I'm also explaining terms, defining this. The terms that Abraham is talking about, I have defined all of them in this lesson. He's highlighted the incremental DTAs, the DTAs, the earnings before depreciation and tax, the terminal cash flows. All these factors I have explained, and it looks complex because you are doing it for the first time. Don't expect to just understand the question once and for all. No, you cannot just understand, or you cannot afford to just give up because it looks complex. You will recall there was a time you are not able to add 2 to 1. If you have a kid, just ask your kid 2 plus 1. The kid, today I asked one who was coming from school, another kid, I asked the kid, what is 1 plus 0? She told me 0, all right? There was a time you are also not able to answer such. So the reason why this one looks complicated is because you are doing it for the first time. And in the event that you get to the exam in the state you are in today, this is a question you avoid doing fast. You know, it's appearing as number 2. So this one you need to run away from it. Do it as a last question if you find it complicated. Then you attempt, say, question 4. If you think it is easy, if you think there is any one that is easier, then you can attempt the ones that are easy so that you get time to come and it's true the question was not direct, because even the initial investment was not provided directly. It had some level of complication, and you've seen it here, because this one would earn you, say, half a mark. Do you understand? This can earn you half a mark, but it is also not direct. There was a working for it. Initial investment, purchase price plus installation cost plus the present value of overhaul cost. So the question was true indeed, not direct, but I've also helped you to how to approach such a question. First, put down the formula, then work downwards. Check from this formula what items can you, because you may not get this answer correct, but there are still, if you have correct workings, you can earn some marks. Okay, if you have done the correct amortization, there is half a mark for that. If you've done the depreciation, you get a mark for all that. So candidates, that is the end of the lesson. In this lesson, we've answered question 2, August 2023. In our next session, we are going to answer question 3, financial management, August 2023. Bye-bye.
We move to question 4. Question 4. I wrap this, assuming we have taken it down. Okay, so we move to question 4 of the paper. Question 4 is all computation. Part A is testing taxation of insurance companies. Part B is testing VAT. So let's start with Part A. Riziki Insurance Company Limited was incorporated in the year 2019. The company deals with different classes of insurance. The following trial balance was extracted from the books of account as of 31st December 2021. So we have a trial balance balancing at 23,420,000 shillings. So it is a trial balance, meaning it has balances of assets and liabilities, it has revenues, it has expenses and all that. So it is upon us, therefore, to differentiate, separate the items that we need and only pick those that we shall use to answer the question. So we have a trial balance. Additional information 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. So this is a question testing taxation of general insurance. Remember, the activities of an insurance company could be in the form of general insurance and life insurance. So the rule is, where an insurance company offers both general insurance and life insurance or life assurance, then the two are treated as separate businesses and they are taxed separately. So this is on general insurance. And general insurance, again, can have different classes. Like in this case, we have motor vehicle insurance and fire insurance. So let's analyze the additional information. 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. Now, claims are almost the major expense of an insurance company. So just like in any other businesses, we can have claims outstanding at the beginning and at the end of the year. So here we have 3 figures that we shall have to adjust for each of these. We have claims outstanding, that is accrued claims brought down, that is at the beginning of the year. We have claims paid during the year and claims outstanding or accrued at the end of the year. So in short, we shall have to adjust the claims account so that we determine the figure to the income statement. 2, an earned premium is maintained at 80% and 50% of the net premiums received for motor vehicle and fire insurance respectively. An earned premium is maintained at 80% and 50% of the net premiums received for motor vehicles and fire insurance respectively. Now, what do we do? In tax, the government taxes taxpayers on income earned, not necessarily what is received. So what we shall do here is simple. We shall work out the net premiums received. Net premiums received is simply total premiums received less premiums returned. In insurance business, as a company, you can receive premiums from your insured, but then because of certain reasons, you may have to return. So net premiums received is simply the difference between the two. So what we shall do is simple. Determine the net premiums received, then deduct the unearned premium so that we only tax that which has been earned. 3, investment allowances have been agreed with the Commissioner at 1.2 million shillings for the year ended 31st December 2021. Investment allowances have been agreed with the Commissioner at 1.2 million shillings for the year ended 31st December 2021. Now, this insurance company has non-current assets, like the first item in the trial balance is property, plant and equipment at 10.2 million shillings. We know this depreciates, but for tax purposes, depreciation is a disallowable expense. Instead of depreciation, we allow for what we call capital allowances or investment allowances, which are computed at a uniform rate for all businesses. 4, so we shall allow this as an expense instead of depreciation. 4, investment income analysis. So in the trial balance, we have an item they are calling investment income, a total of 4.15 million, sorry, 4,150,500. 4,150,500. So this is the analysis. 1, we have interest received from government securities, 2,040,000 shillings net. Net here means after withholding tax has been deducted. So interest received from government securities, 2,040,000 shillings net. Now, interest income is subjected to withholding tax at the rate of 15%. So net here means this figure is 85%. Now, the next thing is, how do we treat interest income received by a company? This is a company. Now, for companies, withholding tax of 15% on interest income is not final tax. So what we shall do is simply to gross the amount given, that is get 100% of it, tax the 100%, but when computing the tax liability, we shall deduct the withholding tax of 15% already paid. Next, we have interest received from local banks. Interest received from local banks, 760,500 shillings net. Net again means after withholding tax of 15% has been deducted. The treatment is the same. We shall gross the amount, tax the gross amount, deduct the withholding tax already paid when computing the tax liability. 3, we have dividend received from a Ugandan company. Dividends received from a Ugandan company. That reminds you to remember your treatment and classification of dividends. Now, this is dividend received from a Ugandan company, meaning it is a dividend income received from outside Kenya. The rule is that is an exempt dividend. So remember your classes of dividends. We have exempt dividends, qualifying and non-qualifying. So this being an exempt dividend of 450,000 shillings gross. Gross means without or rather before any taxes. We shall leave it out as an untaxable income. We have dividend received from a local company of 900,000 shillings net. 900,000 shillings net again means after withholding tax has been deducted. For dividend income, withholding tax rate is 5%. So that means this is 95% of the figure earned. So this is dividend received from a local company. Now the correct classification is this is a qualifying dividend. So what we shall do is simple. Qualifying dividends are dividends whose withholding tax is final tax. So we shall not tax it again. We shall not tax this again because it is already net of withholding tax. 5. Fees paid to investment managers amounted to 750,000 shillings for the year ended 31st December 2021. Fees paid to investment managers. This is an allowable expense, and so we shall show it as one of such. Required: 1. Taxable income or loss for Riziki Insurance Company for the year ended 31st December 2021, and 2. Compute the tax payable, if any. So this is what we do. We say we are answering question 4A. So we show each class in a separate column. So we have motor vehicle insurance, motor vehicle insurance. We have fire insurance. Then we have total here. Then show the currency. Okay. So we start with the premiums. So if you look at the trial balance keenly, there are a number of items touching on premiums. So 1, we have gross premiums received from direct clients. So we can start with that. Gross premiums received from direct clients. So motor vehicle, we have 3 million. Fire is 2.5. The sum should be 5.5 million. Next, we have gross premiums received from agents. So gross premiums from agents. Motor vehicle is 2 million. Fire is 1.2 million. That should be 3.2 million. You can get, if you go to the trial balance again, down, we have what they are calling premiums returned. That is payments that were received from clients, but paid back again. So we have motor vehicle is 800. We deduct. This is 700. A total of 1.5 million. Another thing touching on premiums is whether here up to here we can get net premiums received. Net premiums received. So net premiums received is total premiums received less what was returned. So for fire we have, this is motor vehicle, this is 5. 5 minus 8 is 4.2. So we write here 4.2 million. This is 37 minus that is 3 million, a total of 7.2 million. Then we use information 2 to work out unearned premiums. So we say less unearned premiums. That is 80 and 50% respectively. 80% for motor vehicle and 50% for fire. So we begin, we get 80% of 4.2 million. That is 3360. 3360. So up to there we can get earned premiums. So that will be 3360 from 4200. I get 840,000. We move here. 50% of 3 million is 1.5 million. Less that is 1.5 million. So total earned premium for the year will be the sum of the two. 840 plus 1.5, that should be 2340. This is 15 plus 3360, 4860. Good. Next, we add other taxable income. So we say add other taxable incomes. Add other taxable incomes. We only pick those that are taxable. So we make use of the trial balance and the additional information. One, we have what they are calling commission. Sorry, before we go to other taxable income, there's something else touching on premiums. We have what they are calling reinsurance premiums paid. That is, insurance premiums paid by this company to a reinsurance company. So we should deduct that so that we have what we call net premiums. So we say reinsurance premiums paid. So for motor vehicle it is 400. For fire it is 150. That is 550. So we get the difference again. We get net premiums. This is 440. This is 1340. 1350. 1350 plus 440 should be 1790. 1790. Up to there, we now bring in other taxable income. So say add other taxable income. So we separate the other incomes and only use those that are taxable. One, we have what they are calling in note 4 investment income. Investment income. One, we have interest from government securities. So we write here interest from government securities. So the amount is net, so we gross it. So we shall do 100 over 85 of 2040. We do that together. 100 over 85 times 4, 2040. That gives me 2400, 2.4 million. We add it here. Next we have interest from local banks. Interest from local banks. The same process, 100 over 85 times 760.5. We do it together. I get 894.71. Yes. Dividend from Ugandan company not taxable. Now in exams, if you don't make use of any item provided in the question, please explain why under your notes and assumptions. So you can say under notes and assumptions, one, that dividends from a Ugandan company is an exempt dividend, hence not taxable on Riziki Insurance Company. Again, I repeat, dividends from a Ugandan company are exempt dividends, therefore not taxable on Riziki Insurance Company. Two, dividends received from a local company are qualifying dividends because withholding taxes have already been deducted. So you can say dividends received from a local company are qualifying dividends, hence not taxed beyond withholding tax. Dividends from local company are are qualifying dividends, hence not taxable beyond withholding tax. We go to other incomes, if they are there. we have what they are calling commission on reinsurance ceded. That is a taxable income. Commission on reinsurance ceded. So that reminds you to be able to understand what you call commission on reinsurance ceded and commission on reinsurance accepted. So commission on reinsurance ceded is a taxable income. Commission on reinsurance accepted is an allowable expense. We bring it here. We say commission on reinsurance ceded. For motor vehicle, we have 700. This is 300, a total of 1 million. Any other income? We do not have any other, so we can get total income. Total income. So remember, we are asked to get total taxable income of the company. So we are basically interested in this column here. So we have 1790 plus 2400 plus 894.71 plus 1 million. That should be 6,084.71. That becomes the total income of the business. Because we are using the gross profit approach, we move to the next step and say less allowable expenses. We only use those that are allowable. So we go to the addition information 1, which is about claims. So we run claims as working 1. So I want to run working 1, which is about claims. I can do it here, then we shall wrap. So working 1, claims. So we run claims account. Claims account. So we start with motor vehicle. We are carrying 3 zeros. So if you look at the trial balance keenly, we have what they are calling claims outstanding as at 1st January 2021. That is accrued claims brought down. So motor vehicle, we have 1.1 million. So we write here, balance brought down 1.1 million. Then have balance carried down, information 1. Claims outstanding as of 31st December 2021 amounted to 750,000 for motor vehicles. So we write here 750. Then we debit the account with the claims paid. So we write here bank. So claims paid for motor vehicle is 2770. 2770. Balance of the account. We do it together. 2770 plus 750 is 3520. 3520. Income statement, that is allowable claims, will be that minus 1100, which I get to be 2420. So that will be the allowable claims for motor vehicles. We do it for fire, claims account fire, insurance. The same procedure with the same rules. Balance brought down, that is accrued claims at the beginning of the year. For fire is 840,000. Balance carried down, that is information 1, is 480. Claims paid, bank, fire is 2110. Balance of the account 2110 plus 480 is 2590. 2590. Income statement, that is allowable claims for fire insurance, index 840, 1750. And with that we have the allowable claims. So here we have 2420. Here we have 1750. Get the sum of the two. I get 4170. And with that, we are done with the claims. We are done with this working, so we can grab it. We move to other allowable expenses. We have information 3, which is about investment allowance. So I said those are allowable instead of depreciation. So we write here investment allowances or capital allowances given at 1.2 million total for the year, that is. Information 4 we have talked about, that is the analysis of investment income. Information 5 is about investment managers fees paid. So investment managers fee, a total of 750,000 for both. And up to there, we are done with the additional information. We go back to the trial balance and identify any other allowable expenses. So be very keen. 1, we have commission on reinsurance accepted. Commission on reinsurance accepted for motor vehicle is 600, fire 200, a total of 800. Next we have sundry receivables, that is a balance, not an expense. Bank balance is a balance, an asset, not an item, not an expense. We have directors' fees. This is a company, so directors' fees are allowable expenses. Directors' fees is 495 in total. We bring it here, 495. Reinsurance premiums paid, we have dealt with. Claims outstanding at the beginning of the year, we have dealt with. Claims paid, we have dealt with. Legal costs on claims are allowable expenses. Legal expenses on claims. Motor vehicle is 280. This is 130. 130 plus 280 should be 410. 410. Sundry expenses on motor vehicle claims are allowable expenses. Sundry expenses on motor vehicle claims, a total of 220. Nil for fire, so total is 220. Management expenses are allowable expenses. So management expenses. Motor vehicle 450, 380. That should be 830. Investment income we have dealt with. Premiums returned we have dealt with. Profit and loss account is a balance, not an income, not an expense. So up to there, we can now get taxable income. So taxable income will simply be total income less total allowable expenses. So there are 2 ways of doing it. You can either deduct each of these from the total income, so that would mean we bracket each of them, or we can get total allowable expenses, have it here, then we deduct it from our total income. So let's use the first method. Good. So this is what we are interested in. So we get total taxable income. Be very keen. So taxable income is total income less allowable expenses. So we have 6084.71 less, we are here 4170, 1200, 750, 800, 495, 410, 220, and 830. 830. I have 279, 2790, 2790.29, but negative. So in short, this company realized a loss during the year 2021. So that is part A, Roman 1. Part A, Roman 2 is asking, compute the tax payable, if any. Tax payable, if any. Now, tax is imposed on income. And for a business firm, income is basically profit. So because this particular firm made a loss or realized a loss in this particular year, it is not liable to any tax. So we simply give an explanation for that. So we say part 2, you can write, Riziki Insurance Company Limited is not liable for taxation for the year 2021 because it realized a loss and not a profit. So the company is not liable for taxation in the year 2021 because it realized a loss and not a profit. Then you can go ahead and say tax is imposed on incomes or profit, that is for business purposes. Tax is imposed on income, in bracket profits, but not losses. Yes, so that explains why for this particular year, this company would not have to pay any corporation taxes. And that marks the end of part A of question 4. The topic being tested here is advanced taxation of business income, that is advanced aspects of taxation of business income. The topic is a must in the exam, and in each paper you'll meet at least 2 questions from that particular topic. So be very keen and make sure you understand every bit of it. With that, I want us to move to part B of question 4. Let me wrap this. Part B of question 4. Now, part B of question 4 is a mathematical question again, testing VAT. So that reminds you to have VAT at your fingertips. Know the theory around VAT, it's so much, and then know how to compute VAT and the applicable rules. So I read, be very keen. Zawadi Associates provides consultancy services to various clients whose terms of contract allow clients to pay for the services either before or after the provision of the service. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. So we have a table of 4 columns. The first column is the nature of the service or transaction. Second column is value of the transaction. The third column is service provision date. And then the last column is payment date. So we have a number of transactions and then all those details. Additional information 1. Silock Investments was declared bankrupt on 30th November 2021. Now, Silock Investment was one of the customers, one of the clients, and we are told it was declared bankrupt on 30th November 2021. Let's look at the table and understand what happened in that transaction. So, the transaction was management consultancy to Silock Investment. The value of the service was 1,440,000. The service provision date was 13th November 2021. Payment date was 40% paid on 30th November 2021. 40% paid on 13th November, meaning 40% of the amount was paid on the service delivery date, and the rest was to be paid later. Then come to information 1. This client was declared bankrupt on 30th November. What does that mean? If a debtor is declared bankrupt, it means you cannot recover the debt from them. So it means you have to write it off, and that means you'll have to, it will reduce the amount of VAT you'll collect from this debtor. So what we do is simple. We shall show this as a transaction, yes, but it will be a reduction under output tax. 2. On 5th November 2021, Zawadi Associates renewed its National Industrial Training License for 30,000 shillings and paid for legal fees of 360,000 shillings to follow up on clients who were not paying as per the agreed date. So it had two transactions. One was renewal of industrial training license fee at 30,000. Then 2, it incurred a legal fee of 360,000 to follow up on clients who are not complying with the terms of the contract. So we have to determine if these are vertible or non-vertible items. Now, renewal of industrial trading license fee is not, renewal of national industrial trading license is not a vertible item. So yes, this is an expense, but it will not attract VAT. Legal fees are professional services, and so they will attract VAT. 3. Electricity bill paid on 10th November 2021 was 270,000, out of which 100,000 shillings was payment for outstanding bill for October 2021, and 20,000 shillings was in respect of additional deposit as demanded by the power company. So let's get it keenly. Total amount paid was 270,000 on 10th November. 100,000 out of that was payment for October, and then 20,000 was a deposit for the following month. Now, what does that mean? It means, in short, not the entire 270,000 was relating to November. So what we shall do is simple. We are going to explain what we call tax point, and in this case, we shall have to split this 270,000 for 3 months. 100,000 for October, 20,000 for December or after November. Then the difference, that is 270,000 minus 100 minus 20, that should be 270 minus 120, which is 150, is the amount relating to November. Good. 4. Fuel consumed for partners' vehicles amounted to 90,000 during the month of November 2021. Fuel is a vertible expense, and so we shall charge VAT on that. So we are told it was 90,000, and we are told it was for partners' vehicles. So this means it was for business purposes. Remember, one of the rules in VAT is you can only claim input tax on business expenses or business items, but not private or personal expenses. Computers purchased for business use cost 240,000 in November 2021. Again, this is for business, and so it will attract VAT. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Now, rent is not a vertible item, so we can show it, yes, under input tax, but the rate will be nil. It is an exempt item. 7. Transactions have been stated inclusive of VAT at the rate of 16% where applicable, unless otherwise stated. Now, when computing VAT, the figures given may be inclusive of VAT, to mean the figures already have the VAT amounts within them. So that means if the VAT rate is 16%, then the figures are at 116%. So in that case, be very keen, the VAT rate applicable will be 16 out of 116. So this is where the figures are given inclusive. But where the figures given are exclusive of VAT, it means they do not have the VAT amounts within them. So the figures are around 100%. So it means the VAT rate will be 16%. So this is exclusive. Be very keen on that. Many students confuse the two and they end up with wrong figures, and that makes them fail. Required. 1. Compute the VAT payable by or refundable to Zawadi Associates for the month of November 2021. November 2021. So remember, we have transactions affecting, or rather, touching on October, November, and December. So the question is, compute the VAT payable or refundable to Zawadi Associates for the month of November 2021. Now, this means we have to understand something called tax point. Now, tax point in simple terms is simply the date or the time when VAT is deemed due and payable. The date or time when VAT is deemed due and payable. Now, for local supply, that is for transactions within the country, tax point is the earliest of 4 dates. The earliest to mean that which comes first. 1, the date the services are supplied or the products are supplied or sold. 2, the date when the date when an invoice is issued or received. 3, the date payment is made for part or full settlement of the transaction. And 4, the date a certificate is received. That is in case of transactions requiring supervision, like in constructions where an architect certificate has to be issued and all that. So what we do is simple. Look at each and every transaction, locate the tax point, and if the tax point is November, then we shall capture that transaction in November. If it is not in November, we shall leave it out, because the question is, we compute the VAT payable, refundable for the month of November. So let me use the first transaction, for example. The first transaction was audit services to XL Supermarkets. Audit services to XL Supermarkets. Value of service was 700,000. Service provision date 25th October 2021. Payment date was 5th November 2021. So you can see the service was provided on 25th October, but then the payment was on 5th November. So what does that mean? This transaction should be captured for VAT purposes in the month of October, but not November. So what you do is simple: analyze each transaction, then locate the tax point. If it is within November, capture it under November. We answer that. So this is question 4B. So we say Zawadi Associates value added tax computation for the month of November. For the month of November 2021. So we start with output tax. Output tax is the VAT on sales. Output tax. We arrange it like this. We have date, we have details, we have gross amount in shillings, VAT rate, then VAT amount in shillings. So remember, we have to determine the tax point. So transaction 1 was audit services to XL Supermarkets. The service provision date 25th October. Payment date is 5th November. So that was captured in October. We don't bring it under November. Next, we have training services to Kyle Securities, provided on 3rd November and not yet paid for. So that means the tax point is November. So we write here 2021 November. So the date was November 3rd. The customer was Kyle Securities. The value of the transaction was 240,000. And we are told this is inclusive of VAT. So that means the VAT rate is that 16 out of 116. So we do 16 out of 116 times 240,000. I get 33,103. Sorry, 33,000. Sorry, 16 out of 116 times 240,000, 33,103.45. Next, accountancy services to a total children's home on 5th December 2021, the service provision date. Payment date was 20th November. So November comes before December. So tax point is November 20th. Watoto Children's Home. Watoto Children's Home. Now Watoto Children's Home is, the value is 600,000. This is a service provision to an NPO, a non-profit making organization. So for such, it is nil. That is nil. Debt collection services to Zoella Computers. Service provision date 9th November. Payment date 30th November. So again, this is a November transaction. We take November 9th. That is Zoella Computers. Zoella Computers. 820,000. 16 out of 116. 16 out of 116. 820,000. I get 113, 103.45 again. Next we have strategic plan development to Bazo, that is Rwanda Limited. So the company is in Rwanda. So what does that mean? This was an exported service. For exports, we know VAT rate is nil, 0%. So we write here, the service provision date was 10th November, not yet paid for. So it means it is a November transaction. So we say Bazo, in bracket Rwanda Limited. The amount is 2,150,000. The rate is 0%, meaning the amount is 0. We have management consultancy to Siloc Investment. Service provision date 13th November. 40% paid on 13th November. The rest not yet paid, meaning it is a November transaction. The tax point is in November, that is. So we write here Siloc Investments. 1440,000. 16 out of 116. 16 out of 116 times 1440,000. I get 198 620.69. 620.69. Lastly, we have financial consultancy to before that we have internal controls reviewed of Lema Limited, value 960,000. Service provision date 18th November, but then payment date was 7th October. So it means the payment came before the service provision date. So that means the tax point is in October. So we don't capture that in November. Lastly, we have financial consultancy to W Limited. Service provision date 20th November. Payment date 1st December. So we pick 20th November. So we say W Limited. 1.2 million. 16 out of 116. 16 out of 116 times 1.2 million. 165,000 517.24. Then we have information 1, that is Siloc investment being declared bankrupt on 30th November. So that will reduce the VAT from that in client. So let's understand it. When the service was provided on 13th November, 40% of the amount was paid. That is 40% of 1440,000. Then the rest was not yet paid. And this is on 30th November. So we are not losing the entire amount. What we are losing is simply the VAT on 60% of 1.44 million. So that is what we need. So 60% of 144 million, I get to be 864,000. We should deduct times 16 out of 116. I get 119, 172.24. We deduct because it was a loss, a bankrupt issue. All the rest are transactions affecting input tax. So up to here we get what we call total input tax. Total input tax, total output tax. That is total VAT on sales. We be very keen. 113, 103.45, 198, 620.69, 165, 517.24, less 119, 172.24. I get 391, 172.59. That gives me total output tax. That is step 1. Step 2 is to get our input tax. That is the VAT on purchases and expenses. The same arrangement. So, but we are getting input tax. So we are going to follow the same procedure. But now we are looking at expenses and purchases. Again, we must be keen on which expenses and purchases attract VAT, which ones do not. So I move to information 2, which is about renewal of National Industrial Training License at 30,000 and then legal fees of 60,000 paid on 5th November. So I come here, write 5th November. One, we have National Industrial Training License at 30,000. That does not attract VAT, so the VAT rate is nil. Still on the same date, there was legal fees incurred or paid of 360,000. Legal services are professional services attracting VAT, so 16 out of 116 times 60,000 should be 49,655.17. Information 3 is electricity paid on 10th November. So we write here electricity, but we have to break down the figure. Total amount paid was 270,000. 100,000 out of that was for October, then 20,000 was a prepayment for December, meaning the amount relating to November is only 150,000. So write that. Electricity is a variable expense, so we charge. So 16 out of 116 times 150,000. I'm getting 20,689.66. 4, we have fuel for the partners' vehicles at 90,000 paid in November. So we can write here 10 fuel. That is at 90,000. Fuel is a petroleum product. Petroleum products attract VAT currently at 8%. So if this is inclusive of VAT, it means it will be 8 out of 108. So we shall have 8 out of 108 times 90,000. That is 6,666.67. Then we have computers purchased in November at 240,000 for business purposes. So computers 240,000 for business purposes. I am getting 33,103.45. Note 6. Zawadi Associates paid rent for the month of November amounting to 180,000 on 5th November. So rent is not a vertible expense. The amount was 180,000. The rate is nil. The amount is nil. Transactions have been stated inclusive of VAT. So up to here we get total input tax. Total input tax. The sum of all that 49,655.17 plus 2689.66 plus 666.67 plus 33,103.45. I get 114.95. That is total input tax. The next step now is to compute VAT payable or refundable. Now in this case, this trader had both taxable supplies and non-taxable supplies. So what we do therefore is to restrict the deductible input tax. So we say VAT payable or refundable is equals to output tax less deductible input tax. Deductible input tax is equals to taxable supplies divided by total supplies times input tax. Taxable supplies are simply those supplies attracting VAT, that is sales at standard rate and sales at zero rate. Total supplies will be taxable supplies plus now the exempt sales or those sales attracting VAT at nil rate. So we go back to our output tax table. So if you are keen, we have supplies attracting VAT at standard rate, those at nil rate and those at zero rate. So to get the numerator here, this figure here, we add all the transactions attracting VAT at nil rate, at zero rate and at standard rate. So look at the table keenly. We pick everything, that is the gross amount for every transaction, except those attracting VAT at nil rate. So if you are keen, if you are there, we have the list. There is one transaction attracting VAT at nil rate, that is the supply to Watoto Children's Home, which I said is an NPO. So it means we get the sum of everything except that 600,000. So do it with me. We have 240,000 plus 820,000 plus 2150,000 plus 1440,000 plus 1.2 million, then minus 864,000, that is the budget return of So I get 49,86,000. So we say this is equals to 49,86,000. To get the numerator, simply add exempt transactions to that figure. And in our case, we only have one of 600,000. To that figure, we add 600,000. I get 86,000 times input tax. Input tax is here, 114.95. So we get it together. So we have 49,86,000 divided by 55,86,000 times 114.95. I get 98,287.35. Therefore, we say VAT payable. It is VAT payable where the total output tax, our total output tax we got to be 391,152, is more than the deductible input tax, which is 98,287. Where it is the other way around, it becomes VAT payable. So we say VAT refundable. So we say therefore VAT payable will be equal to 391,152 .12 minus 98,287.35. You do that. So 391,152.12 minus 98,287.35. I get 292,864.77, and that becomes the VAT payable for this particular month of November 2021 by this firm. And that marks the end of question B, part 1. We move to part B, Roman 2 of the question. It says, Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Advise Zawadi Associates on the tax point in respect of such services. Advise Zawadi Associates on the tax point in respect of such services. This is again touching on what we have been talking about. Now, in this case, this company is planning to engage a firm of consultants from South Africa. So what does that mean? It means, in short, it will be importing this particular service from South Africa. Now, the rule is that for imported products, that is for imported goods and services, tax point is the earliest of 3 dates. Earliest of 3 days. Number 1 is the date when the service is provided. 2, the date when payment is made in full or part settlement for the contract. And 3 is the date when the invoice is issued. So in short, you can say tax point for imported services is the earliest of the following 3 dates. Tax point for imported services or products is the earliest of the following 3 days. 1, the date when the services are rendered or provided. 2, the date when an invoice is received. And 3, the date when payment is made in full or part settlement for the contract. So in short, for Zawadi Associates, the tax one, that is the date when they will have to account for that particular transaction under VAT, will be earliest of those 3 particular days. And that earns you the 3 marks awarded there. And that marks the end of question 4. Yes. Again, that reminds you that VAT is a very common exam area. Be very familiar with it, know the theory part of it and the computation part of it. The rules as well around VAT computation. A very important part is to know the classification of supplies. We know not all supplies are VATable, so we should know which supplies are VATable at standard rate, which ones are VATable at zero rate, and which ones are VATable at, which ones are exempt supplies. Yes, and that is it.
Hello to you all and welcome to the lesson. The subject is company law. We're going to begin revising the paper that was done in April 2022 by the CPA and certified secretaries. Now, the paper has 7 questions. Candidates were to answer 5 questions. Time allowed 3 hours. We'll be answering a question at a time. In every session, we'll be answering 1 question. For example, in this session, I'm going to answer question number 1. The next session, I'll answer question number 2. Like that until we answer the 7 questions. It's my hope you're ready to revise. I urge you to be looking at the questions before attending these sessions. Make sure you answer the questions on your own first. Let's begin with question number 1, part A. Highlight 6 ways in which a person may become a member of a company. 6 marks. Highlight 6 ways. Company law, April 2022, question 1A. 6 ways in which a person may become a member of a company. 6 ways in which a person may become a member of a company. The first way is through subscribing to the memorandum. Subscribing to the memorandum. Now, the subscribers to the memorandum are deemed to have agreed to become members of the company, and on its registration, their names are entered in the register of members. That's the first way. The second way is through allotment. Allotment is the second way in which a person may become a member of a company. A person to whom shares are allotted by the company pursuant to an application on flotation becomes a member when his name is entered into the register of members. The third way is through transfer. This is the purchase of shares from a willing member, that is, the transferee becomes a member when the transfer is registered and his name entered into the register of members. So if I'm a member of company A and I'm willing to sell my shares to you, to transfer my shares to you, then you can become a member of company A through transfer, which is the purchase of shares from me, a willing member of the company, who would willingly transfer the shares to you after you pay through a stock broker. Transfer. Then there is transmission by death. Transmission by death. Transmission by death. Now, the shares of a deceased member pass to the person, or I can say the shares of a deceased person, this is a person who has died, may pass to the personal representative by operation of law, by operation of law. So transmission by death. So if one dies, then the personal representative of the one who has died becomes a member of a company through operation of law. 5, transmission by bankruptcy. Transmission by bankruptcy. Now, under the provisions of the Bankruptcy Act, the shares of a member declared bankrupt by a court of competent jurisdiction pass to the trustee in bankruptcy. So transmission by bankruptcy is another way in which a person may become a member of a company. The 6th way is share qualification of directors. Share qualification of directors. Share qualification of directors. A person who has delivered to the registrar an undertaking to take and pay his qualification shares is deemed to be in the same position as a subscriber to the memorandum for that number of shares. So share qualification of directors is another way in which a person may become a member of a company. There are many ways other than these 6, like estoppel, through the doctrine of equitable estoppel. Equitable doctrine of estoppel. A person can also become a member by agreement to become a member and entry on the register of members. So these are 6 ways. 1, subscribing to the memorandum through allotment, through transfer, transmission by death, transmission by bankruptcy, share qualification of directors. 6 ways, 6 marks. 6 ways, 6 marks. I'm going to answer part B. Identify 4 types of particulars to be registered with respect to a company's beneficial owner. Types of particulars to be registered with respect to company's beneficial owner. Company's beneficial owner. Who is this owner? Beneficial owner. Now, candidate's beneficial owner means the natural person who ultimately owns or controls a legal person or arrangements, or the natural person on whose behalf a transaction is conducted. And beneficial owner includes those persons who exercise ultimate effective control over a legal person or arrangement. The question is, what are the types of particulars to be registered with respect to a company's beneficial owner? Number 1, full name. Number 2, identification card, that is personal identification card or national identity card. The national identity card number, national identity card number. Or it can be passport number. Then there is personal identification number, popularly known as PIN. Full name, National Identity Card, also known as the ID. The personal identification number, also known as the PIN. Telephone numbers, telephone numbers is another type of particular to be registered with respect to a company's beneficial owner. Telephone numbers. If one has telephone numbers, there is current email address. All right. Current email address. Another particular is occupation. What is the occupation of the beneficial owner? Is it a teacher, a carpenter, a videographer, an accountant? What else? What else? Current email address, occupation. The other particular is the date on which a person became a beneficial owner. The date on which a person became a beneficial owner. The date on which a person became a beneficial owner. Another one could be the date on which any person ceased to be a beneficial owner. The date on which a person ceased to be a beneficial owner. The date. So you have to identify just 4. There are many particulars candidates. They are not 4. They are not 8. They could be 10. Like we can add any detail. Or let me say the name of ownership control. The name of ownership or control, because we are talking about beneficial owner. The nature of ownership or control. All right? The nature number 9, nature of ownership or control. The nature of ownership or control. So these are some of the types of particulars to be registered with respect to a company's beneficial owner. Full name of the beneficial owner, the national ID of the beneficial owner, the PIN, telephone numbers, current email address, the occupation of the beneficial owner, the date on which the person became a beneficial owner, the debt on which the person ceased to be a beneficial owner, the nature of ownership or control. Any 4 here would earn 4 easy marks. These are 4 easy marks for any 4 points, 4 easy marks. Let's move on to answer part C, which says a person dealing with the company is entitled to assume, in the absence of facts putting him in doubt, that there has been due compliance with all matters of internal management and procedure required by Articles of Association. With reference to the rule in Royal British Bank versus Taquant, summarize 5 exceptions to the above statement. Exceptions to the Taquant rule. Now, before we answer, we put down the exceptions. It's important for us to revise. What is this rule, the Taquant rule? Now, learners, the Taquant rule is a rule that came about as a result of the case between Royal British Bank versus Taquant. And Taquant was the official manager or the liquidator of the insolvent Camerons, Colebrook and Swansea and London Railway Company. And it was incorporated under the Joint Stock Companies Act. The company, this company, had given a bond for 2,000 sterling pounds to the Royal British Bank, which secured the company's drawings on its current account. The bond was under the company's seal, signed by directors and the secretary. So the company alleged that under its registered deed of settlement, which is just the Articles of Association, directors had no powers to borrow. All right? The directors had what? Had no, the directors had powers to borrow what had been authorized by the company's resolution. Do you understand? The company, which had borrowed money from the Royal British Bank, alleged that under the Articles of Association, directors had powers to borrow what has been or what had been authorized by the company's resolution. And a resolution had been passed, but not specifying how much the directors could borrow. So the company, in this case, claimed that there was no resolution passed authorizing the issue of the bond, and that therefore the company was not liable. So you see the case pitting, that's the case pitting the Royal British Bank and Taquant. Taquant was the liquidator of the insolvent Cameron, Colebrook and Swansea and London Railway Company. So this company borrowed money from the bank through a bond, which secured the company's drawings on its current account. So the company failed to repay the money under the argument that there was no resolution that was passed authorizing the issue of the bond, and that therefore, the company was not to be liable for the 2,000 sterling pounds. And it was held that the company was entitled to sue on the bond, as the requirement for the resolution was a matter of internal regulation for the company, and the bank could not know whether such resolutions had in effect been passed, and it was entitled to presume that the resolution had indeed been passed. That's why this law or this rule is also known as the rule of indoor management. The indoor management rule. It is on the basis of this rule which I read, a person dealing with a company is entitled to assume, in the absence of facts putting him in doubt, that there has been due compliance with all matters of internal management and procedure required by articles of association. With reference to the rule in Royal British Bank versus Taquant, summarize 5 exceptions to the above statement. What are the exceptions? The rule is that people dealing with the company ought not to bother much whether the company has complied with its internal policies or complied with the articles of association. The court held that the company was entitled to sue on the bond, as the requirement for the resolution was a matter of internal regulation for the company. And the bank could not know whether such resolutions had in fact been passed. The company was entitled to presume that the resolution had indeed been passed. So what are the exceptions to this rule? One is where an outsider has information or knowledge of irregularity. Outsider has knowledge of an irregularity. Where an outsider has knowledge of an irregularity, then that will be an exception to the Taquant rule. The first and the most obvious restriction is that the rule has no application where the party affected by an irregularity had actual notice, all right, had actual notice of the irregularity. And knowledge of an irregularity may arise from the fact that the person contracting was himself a party to the inside procedure. For example, in this case, if the bank had knowledge of the goings-ins, the workings or the internal affairs of the company, then the company could not be entitled to sue on the bond. So this is an exception to the Taquant rule. The second point is suspicion of an irregularity. Suspicion of irregularity. Now, the protection of the Taquant rule is also not available where the circumstances surrounding the the contract are suspicious and therefore invite inquiry. And suspicion should arise, for example, from the fact that an officer is purporting to act in a manner which is apparently outside the scope of his authority. Number 3, forgery. Forgery. Forgery may, in circumstances, exclude the TAC-1 rule. For example, the company secretary who affixes the seal of the company and forges the signature of the directors and goes ahead to issue the certificate. That will, the TAC-1 rule in such a case will not apply. Forgery. 4, representation through the articles. Representation through the articles. Now, the exception deals with the most controversial and highly confusing aspect of the TAC-1 rule. And the articles of association generally contain what is called the power of delegation. The effect of the delegation clause is that a person who contracts with an individual director of a company, knowing that the board has power to delegate its authority to such an individual, may assume that the power of delegation has been exercised. And to that effect, the exceptions, that becomes an exception to the TAC-1 rule. Number 5, acts outside apparent authority. Acts outside apparent authority. Now, if the act of an officer of a company is one which would ordinarily be beyond the power of such an officer, the plaintiff cannot claim the protection of the TAC-1 rule simply because under the articles, power to do the act could have been delegated to him. In such a case, the plaintiff cannot sue the company unless the power has in fact been delegated to the officer with whom he dealt. With whom he did what? With whom he dealt. So these are 5 exceptions to the TAC-1 rule. 1, 2, 3, 4, 5, 10 marks. 10 marks. And that effectively brings this lesson to an end. We've answered question number 1. In our next class, we are going to answer question number 2, which is in 3 parts, A, B, C. Please try and attempt question 2 before attending the next session. Thank you. God bless you. Bye-bye. Hello everyone and welcome to the lesson. We will today answer question number 4, April 2022. The paper is Company Law. Part A reads, Roman 1, in relation to mergers and acquisitions, explain the term merger. The meaning of merger. A, Roman 1. Of the term merger. What is the meaning of the term merger? From the word merge, to merge. Merging means coming together. In acquisitions and mergers, that would mean or represent the absorption of one company by another. It is the absorption of one company by another. That is, one of the companies remains and the other ceases to exist as a separate entity. So if company A and B merge, and it's A that is merging with B, then one of these companies ceases to be, such that there is only either company A or company B. It represents the absorption of one company by another, such that one of the companies remains and the other ceases to exist as a separate entity, to exist as a separate entity. That is the meaning of the term merger. 2 marks. Then Roman 2, in a takeover situation, the acquiring company is called the predator, while the company being acquired is called a target. With reference to the above statement, discuss 4 methods which the predator might use to pay for the purchase price of the target company. Methods which the predator might use. Roman 2. Methods which the predator might use to acquire the target. Now there are various methods that the predator might use to acquire the target. The first one is share for share exchange. Share for share exchange. Now, in this case, the predator will be given a number of shares for every share of the target acquired. Share for share exchange. The targeter will do what? Will be given a number of shares for every share of the target. That is one way. The second method or way in which the predator might use is by use of cash. Now, instead of exchanging the shares, the shareholders of the target can be given cash. The shareholders of the target receives a cash payment so that they can surrender their shares to the predator. Use of convertible securities. Use of convertible securities. The shareholders of the target surrender and then become either debenture holders or preference shareholders. So they surrender their shares in exchange for debentures in the predator's company. Use of convertible securities. Then lastly is a combination of any of the above methods. Combination of any of the above methods. It could be a combination of either the share for share exchange, part of the shares are exchanged, the remaining shareholders are given cash. That is one combination. You may have combination of share for share exchange and the use of convertible securities. You can have a combination of cash and use of convertible securities. You can have a combination of use of cash and convertible securities. You can also, those are the combinations. Combination of either or any of the above methods. So these are the methods which the predator might use to acquire the target. How many marks? 8 marks. 1, 2, 3, 4. Each one there 2 marks total, 8 marks. 8 marks. So that is question 4, part A. Then part B of this question reads, with respect to audit of company accounts, state 4 grounds which might disqualify a person from being appointed as an auditor of a company. Grounds for disqualification. Grounds which might disqualify a person from being appointed an auditor of a company. Straightforward question. Grounds which might disqualify a person from being appointed an auditor, from being appointed as an auditor of a company. Now the first ground is conviction. If a person is convicted in a court of law, if a person is convicted by a court of law, all right, a court of law with competent jurisdiction in Kenya or elsewhere of an offense involving fraud or dishonesty. Conviction by a court of law, court of competent jurisdiction, conviction by a court of competent jurisdiction for offense of fraud or dishonesty. That can disqualify someone from being appointed as an auditor of a company. Number 2, if such a person is declared bankrupt, such a person is declared bankrupt, what we call the undischarged bankrupt. Undischarged bankrupt. That can also disqualify a person from being appointed as an auditor of a company. The third ground is unsound mind. If a person has a mind that is not sound, if a person is insane, then such a person cannot qualify to be appointed as an auditor of a company. Insanity disqualifies one from being appointed as an auditor of a company. An employee of the company. If one is an employee of company A, then such a person does not qualify to be an auditor of such a company. If a person is an officer or an employee of the auditee, that is the audited company, then you cannot qualify to act as an auditor of such a person. A partner. If one is a partner or employee of the audited company, a partner of the audited company, or a partnership of which such a person is a partner. Okay? If such a person is what? Is a partner of the audited company, or such a person is in partnership of which he is a partner. So a partner of a company cannot also qualify to be appointed as an auditor of such a person. So candidates were to give 4 grounds. There are many grounds. Conviction by court of law, court of competent jurisdiction for offense of fraud or dishonesty, an undischarged bankrupt, and sound mind, an employee of the auditee company, a partner, an officer or employee of an associated undertaking of the audited company, and so on. So these are the grounds which might disqualify a person from being appointed as an auditor of a company. 1, 2, 3, 4. Any 4 points, 4 marks. Then the last part of this question reads, describe 3 characteristics of a debenture which creates a floating charge on the assets of a company. Characteristics. Characteristics of a floating charge. But first of all, what is a floating charge? All right, characteristics of a floating charge, characteristics of a debenture which creates a floating charge. What is a floating charge? Now, candidates, a floating charge is when a debt is secured against a group of non-constant assets. These are assets that may change in value or quantities. All right? That's the meaning of floating charge or floating lien. And candidates were expected to give characteristics of a floating charge. What are the characteristics? Number 1, it is a charge on a class of, number 1, it is a charge on a group or a class of assets, both present and future. It is a charge on a class of assets, both present and future. That's the first characteristics. It is a charge on a class of assets which are both present and future. These are assets that change in value and quantities over time. Then the second characteristic is that the class of assets is one in which the ordinary course of business of the company would be changing from time to time. The value of these assets is their nature to change, floating, to change over time, from time to time. The class of assets is of one in which the ordinary course of its business of the company would be changing from time to time. Then the third characteristic of a floating charge is that it is contemplated that until the charge attaches to assets by crystallization, the company may dispose of or deal with the assets in the ordinary course of business. The company may dispose of or deal with the assets in the course of its business, or deal with the assets. The company may, 1, dispose these assets in the course of its business, or it can deal with the assets in the course of its business. These are 3 characteristics of a floating charge. 1, 2, 3, 6 marks. Yes, 6 marks. So 6 plus 4 marks plus 8 marks plus 2 marks is equal to 20 marks. That is what was required of the candidates who sat in this paper as far as question 4 is concerned. Thank you for attending this session. In our next session, we are going to answer question number 5. Make sure you attempt the question before attending our next session. God bless you. Bye-bye. Hello and welcome to the lesson. We are going to revise the August 2022 question 6. The subject is ICT. Question 6A reads, an insurance company has decided that it no longer requires a physical head office. Its strategic aim is to become a virtual organization. The company's auditors have concerns that information held by the virtual company would lack security. Required, describe 3 measures that could be adopted to ensure the information in insurance company remain secure. Currently, this question we've answered it several times. The question is in relation to data security. This company has decided to become a virtual organization, meaning that it will no longer have physical presence, but will operate digitally. But the company's auditors are concerned that information held by the virtual company would lack security. So what are the measures that could be adopted to ensure that the information of the company remains secure? The first measure is encryption. Encryption. Implementing strong encryption techniques for sensitive data will be crucial to ensure its security. The second measure is multi-factor authentication. Multi-factor authentication. Then number 3, the third measure is security remote access. Security remote access. So we are going to discuss those 3 measures to safeguard against the lack of security of the information of this insurance company that plans to go virtual. So that's part A of the question. Measures that could be adopted to ensure that information is secure. The first measure I've said, measures to secure information of a virtual insurance company. The first one is encryption. Encryption. The company should encrypt data both in transit and at rest using robust encryption algorithms and secure key management practices. That will ensure that even if unauthorized individuals gain access to the data, they cannot decipher its contents without the appropriate decryption keys. You encrypt. If you want to get access, you have to decrypt. Encryption. Multi-factor authentication. Authentication. 2. Multi-factor authentication. Multi-factor authentication. Implementing multi-factor authentication adds an extra layer of security to access sensitive information. That involves requiring users to provide multi-forms of identification such as password or fingerprint scan or one-time authentication code. So multi-factor authentication reduces the risk of unauthorized access to the company system and data, as it becomes more challenging for attackers to bypass the authentication process. multi-factor authentication. Security remote access. As a virtual organization, employees may need to access company systems and data remotely. So it is important to implement secure remote access solutions such as virtual private networks, what we call the VPNs, or secure remote desktop protocols. Such technologies create an encrypted tunnel between the remote device and the company's network, ensuring that data transmitted over the internet remains secure and protected from interception by unauthorized individuals. So those are 3 measures to secure information of this virtual insurance company. 6 marks. 6 marks. 2 marks, 2 marks, 2 marks, 6 marks. Part B. Highlight 3 challenges of prosecuting ICT cases in court. Challenges of prosecuting ICT cases in court. The first one is technical complexity. First challenge, technical complexity. Technical complexity. ICT cases often involve complex technological concepts and evidence which can be challenging for non-technical judges and lawyers to understand. So presenting evidence in a clear and comprehensible manner may require the involvement of expert witnesses or specialized forensic investigators, which adds complexity to the legal proceedings. Technical complexity is one challenge. Number 2, jurisdictional issues. Jurisdictional issues. With the global nature of ICT, jurisdictional challenges may arise when attempting to prosecute cases that involve actors or incidents across different jurisdictions. And determining which jurisdiction that has the authority to prosecute and coordinate international cooperation can be time-consuming and complicated. Jurisdictional issues. The third challenge of prosecuting ICT cases in court is digital evidence preservation. Digital evidence preservation. ICT cases heavily rely on digital evidence, which can easily be manipulated. It can be easily be deleted or destroyed if proper preservation techniques are not employed. So ensuring the integrity and the admissibility of digital evidence requires specialized tools and techniques for data collection, preservation, and data analysis. And failure to properly handle digital evidence can weaken the prosecution's case. So it is important for legal professionals involved in ICT cases to have a solid understanding of technology and also to stay updated on evolving trends and challenges in order to effectively navigate these complexities during legal proceedings. 1, technical complexity. 2, jurisdictional issues. Number 3, digital evidence preservation. Those are 3 challenges, 3 marks. We've answered part B. Now going to answer part C. Explain 4 application areas of cloud computing technology in governance, accounting services. Governance and accounting services. Application areas of cloud technology. Application areas of cloud technology. Number C. application areas of cloud technology in governance stroke accounting services firms. In governance stroke accounting services, application areas of cloud technology in governance stroke accounting services firms. The first application is data storage and backup. Data storage and backup. Cloud computing provides a secure and scalable platforms for securing and backing up critical data. So the firms can leverage cloud storage services to store their data. If it's the accounting firm, that will be the accounting or financial records or audit logs or any other important documents to ensure that data is available and reliable, and also to ensure data recovery. Data storage and backup. Collaboration and communication, number 2. Collaboration and communication. Collaboration and communication. Cloud-based collaboration tools enable real-time collaboration and communication among team members, both within the firm and with external stakeholders, and that allows seamless collaboration on financial reporting, auditing, compliance activities, and thereby improving efficiency and productivity. Collaboration and communication. Number 3, software application as a service, abbreviated as SaaS. Software application as a service. Now, cloud-based computing and governance software applications can be accessed and used via the internet, eliminating the need for on-premises installation and maintenance. So SaaS solutions provide the firm with access to up-to-date accounting software, regulatory compliance tools, and other specialized applications, reducing costs and enhancing agility. 4, and this 4th one is a common answer: scalability. Scalability and flexibility. This one I've written on this board many times. Scalability and flexibility. Cloud computing allows the firm to scale its computing resources based on demand, and that particularly is useful during peak periods such as tax season or financial reporting deadlines, when additional computing power may be required. So cloud platforms provide the flexibility to adjust resource allocation in a dynamic way, ensuring optimal performance and cost efficiency. So these are 4 application areas of cloud technology in governance and accounting services firms. 1 is data storage and backup. Number 2, collaboration and communication. Number 3, software application as a service. Number 4, scalability and flexibility. 4 marks. That is part C. Part C. We are answering question number 5, number 6. Part D reads, identify 5 major management challenges to building and implementing information systems within an organization. Another common question, which I have answered here several times. Challenges. or to building and implementing information systems. Challenges to building and implementing information systems. Challenges to building and implementing information systems. What are the challenges? The first challenge is alignment with business goals. Alignment with business goals. Alignment with business goals. Alignment with business goals. Candidates, ensuring that information systems align with the organization's strategic objectives and supports its core business processes is a significant challenge. It requires a clear understanding of business requirements and effective communication between the IT and the business stakeholders to align the information system with business goals is not a mean task. It's a big challenge. So we are discussing building and implementing. Building and implementing. Challenges of building and implementing information systems. Another challenge is resource allocation. Allocating resources. Resource allocation and budgeting. Now, building and implementing information systems require significant financial and human resources. So, allocating appropriate resources, managing budgets, prioritizing projects can be challenging, especially where there are competing demands for limited resources. So, resource allocation and budgeting is a challenge. The third challenge, candidates, is change management and user adoption. Change management and user adoption. Introducing a new information system often involves changes to existing processes, workflows, and job roles. So managing change effectively needs addressing resistance also, and ensuring that user adoption are critical for successful implementation. And therefore, training and communication strategies are key components of addressing such challenges. Change management and user adoption, because when implementing an information system, the existing processes, the workflows, and even job roles, the changes to such processes are inevitable, and naturally people resist change. So it's important to have proper communication and training during the building and implementing of an information system. Otherwise, workers may resist. So change management and user adoption is a challenge. So that is part D. Candidates were to give 5. These are just 3. Let's highlight the other 2 challenges. This is number 4. data quality and integration. Data quality and integration. Information systems rely on accurate and integrated data delivery and ensuring that data quality and data integration across various systems and also data governance are essential challenges in building and implementing information systems. Data quality and integration. I've said that information systems rely heavily on accurate and integrated data to deliver reliable insights and support decision making. So it's important to ensure data quality. It's also important to ensure integration of data across various systems, and data governance, I've said, are essential in building information systems. Data quality and data integration. Security and privacy is another challenge. Security and privacy. Security, how is security and privacy a challenge, or why is security and privacy a challenge? Now, candidates' information systems store and process sensitive data, making security and privacy a major concern. So protecting data from unauthorized access, ensuring compliance with the regulatory or with the regulations, and also implementing appropriate security measures are critical management challenges in information system development and implementation. So these are 5 challenges. 1, alignment with business goals. 2, resource allocation and budgeting. 3, change management and user adoption. 4, data quality and integration. 5, security and privacy. 5 marks. 5 marks. Part E, outline 2 limitations of touchscreen as an input device. Limitations of a touchscreen. DE, limitations of a touchscreen. Limitations of a touchscreen as an input device. What are the limitations? The first limitation of a touchscreen as an input device is lack of tactile feedback. Lack of tactile feedback. Unlike the traditional input devices like the keyboard or the mice, touchscreens do not provide physical keys or buttons, and that absence of tactile feedback can make it challenging to type accurately, which may result in errors, especially for users who rely on touch typing or who are accustomed to physical buttons. Lack of tactile feedback. There is also limited precision with touchscreen. Limited precision. Touchscreens may do what? May have limitations in terms of precision, especially when it comes to small targets or precise movements. So the size of fingers, or even what we call stylus tips, can make it difficult to accurately interact with small elements or perform precise actions, such as drawing or selecting small objects on the screen. So there could be a small object on the screen, but the finger is big. So you see, that is a challenge. And therefore it's important to know that touch screens have evolved and improved over time, and these limitations may vary depending on the specific touchscreen technology. It may also vary depending on the device. Additionally, user experience can be enhanced through features like haptic feedback or stylus support. So these are two limitations of touch screen as an input device. Number one is lack of tactile feedback. Number two, in some instances, it can give you limited precision. Two limitations, 2 marks. Two limitations, 2 marks. So these are how many marks? We have 6 plus 4 giving us 10, then 3 plus 2 plus 5, 10, total 20 marks. So that is a solution to August 2022 question 6. Information Communication Technology is the paper that was done by CPA foundation level candidates and CS foundation level candidates. Thank you for attending the lesson. In our next session, we are going to answer question 7 of the same sitting, August 2022. Bye-bye. Hello everyone, and welcome back to the lesson. We are going to answer the last question from the August 2022 sitting. The subject is ICT. Question 7A, I read, explain 3 legal issues involved when a person who is a resident in Kenya or your country wants to purchase a car offered for sale in Japan via a server in Hungary. Assume he is doing online purchase through e-commerce. I repeat, explain 3 legal issues involved when a person who is a resident in Kenya or your country wants to purchase a car offered for sale in Japan via a server in Hungary. Assume he is doing online purchase through e-commerce. Now there are 3 legal issues there. The first one is jurisdiction. The second legal issue is international trade regulations. And then the third one is consumer protection. Those are 3 legal issues involved in purchasing a car offered for sale in Japan via a server in Kenya through e-commerce or any country. All right, your country. So let me answer the question. Legal issues involved. A, legal issues involved are, I've said jurisdiction is the first legal issue. Jurisdiction. Determining the appropriate jurisdiction for legal disputes can be complex in cross-border e-commerce transactions. We've seen that this buyer in Kenya is buying a car from Japan. So the question is, if there are any legal disputes between these two persons, if there are any legal issues, then determining the appropriate jurisdiction for settling the dispute can be a challenge. And in this case, the buyer residing in Kenya or another country may need to consider which country's laws will apply in case of any legal issues or even disputes that may arise from the transaction. Then the second legal issue is international trade regulations. International trade regulations. Purchasing a car from another country involves compliance with international trade regulations such as export, import laws. It may also include customs duties and taxes and so on. So the buyer needs to ensure compliance with applicable regulations in their country and also to understand any potential legal obligations or restrictions involved in importing the car. So that is the second legal issue, international trade regulations. Number 3, consumer protection. Consumer protection. Online purchases require consideration of consumer protection laws and regulations, and the buyer needs to be aware of their rights regarding product quality, warranties, refunds, and also returns. And understanding the legal recourse available in case of any issues with the car is important to protect the buyer's interests. So these are 3 legal issues. Number 1, jurisdiction. Number 2, international trade regulations. Number 3, consumer protection. 3 marks. That's part A. Part B, John Mbululu intends to implement cloud computing in his organization, but he has several concerns about cloud computing. Suggest 3 possible concerns for John Mbululu. It's a common question which we've answered many times here. Concerns in relation to cloud computing. Possible concerns for John Mbululu. Part B, you've read that John Mbululu intends to implement cloud computing. Possible challenges for implementing cloud computing. The first challenge is data security and privacy. Data security and privacy. John Mbululu may have concerns about the security and privacy of his organization's data when stored and processed in the cloud, and he may worry about unauthorized access, data breaches, or the potential for data loss. So addressing these concerns requires implementing robust security measures and ensuring compliance with data protection regulations. So data security and privacy is one of the possible challenges associated with cloud computing. Number 2, reliability and availability. Reliability and availability. John Mbululu may be concerned about the reliability and availability of cloud services. He may worry about potential downtime, service disruptions, or the ability of the cloud provider to meet the organization's uptime requirements. So it's important to evaluate service level agreements and the key track record of the cloud provider, which can help address such concerns. Reliability and availability. John must be concerned with the reliability of cloud computing services and availability. Vendor lock-in. Vendor lock-in. Vendor lock-in. And that can be discussed together with data portability. Data portability. John Bululu may have concerns about vendor lock-in, which refers to the dependency on a specific cloud provider and the challenges of migrating to different providers or bringing the data back in-house. Vendor lock-in is a challenge. So he may want to ensure that the organization can easily transition to another cloud provider if needed and have control over its data. So vendor lock-in and data portability is a possible challenge associated with cloud computing. So these are three challenges. Part B suggests three possible challenges. So these are three possible challenges: data security and privacy, reliability and availability, vendor lock-in, and data portability, 3 marks. Part B. Part C reads, one technique for gathering requirements during system development is the use of workshops. Discuss 2 advantages and 2 disadvantages of using workshops for requiring or for requirements gathering. Advantages. This is C. Advantages of using workshops for requirements gathering requirements. What are the advantages? Now, there are various advantages and disadvantages of using workshops for requirements gathering. The first advantage is collaboration and stakeholder engagement. Collaboration and stakeholder engagement. 1. Collaboration and stakeholder engagement. Workshops allow for direct interaction and collaboration between the system developers and stakeholders because they provide a platform for stakeholders to share their perspectives, their requirements, insights, enabling a better understanding of their needs because it's physical. Workshops enables collaboration and stakeholder engagement. Number 2, efficient and focused communication. Efficient and focused communication. Workshops provide a structured environment for gathering requirements, allowing for efficient communication and clarification of requirements, and it enables immediate feedback. It enables discussions and brainstorming sessions, leading to a more comprehensive and accurate understanding of the system requirements. So these are 2 advantages of using workshops: collaboration and stakeholder engagement, efficient and focused communication, 2 marks. So these are advantages. We are now going to highlight the disadvantages. These are disadvantages of using workshops for requirements gathering. The first disadvantage is in relation to resources and time. Time and resource intensive. It is 1, time and resource intensive. Time and resource intensive. Conducting workshops requires the participation of multiple stakeholders, which can be time consuming and may require significant resources. For example, there could be scheduling workshops that accommodate all stakeholders, and that can be challenging, leading to potential delays in the requirements gathering process. Time and resource intensive. The second disadvantage, group dynamics and bias. Group dynamics and bias. Workshops involve group discussions and interactions, which can be influenced by individual biases, dominant personalities, or groupthink. So certain stakeholders may exert more influence, and some ideas or requirements may be overlooked or suppressed, leading to potential biases in the gathering of requirements. So it's important to note that the effectiveness of using workshops for effective gathering depends on factors such as the complexity of the system, the size of stakeholder groups, and also the facilitation skills of the workshop leader. So these are advantages, 2 advantages and 2 disadvantages of workshops as a tool or method for requirements gathering. The first disadvantage is time and resource intensive. It is time and resource intensive. Then it can also be influenced by group dynamics and bias. 2 marks. 2 disadvantages, 2 marks. We've answered that part of the question. We will now answer part D. To minimize resistance during system changeover, it is always necessary to involve users. Identify 4 different ways of involving users in the system development process. Ways of involving users in system development process. D1. Ways of involving users in system development. Ways of involving users in system development. Candidates, there are different ways of involving users in system development process. One way is user interview. User interviews. User interviews. Interviewing the users. Conducting one-on-one interviews with users to gather their requirements, understand their needs, and incorporate their feedback into the system design. We may also have user surveys. User surveys. Other than user interviews, another way is through user surveys or even questionnaires. That can be done by administering administering surveys and questionnaires. Administering surveys and questionnaires to users in order to collect their opinions, their preferences, and suggestions, because that will then allow for gathering and also getting large amounts of information or feedback from a wider user base. User survey / questionnaires. There may also be, we've just mentioned another way here, workshops. User workshops. User workshops. Workshops can be conducted, or focus groups. Organizing workshops or focus groups where users can actively participate share their opinions, their experiences, discuss requirements, and also collaborate with system developers. And that fosters collaboration and ensures that users' perspectives are considered. User workshops and focus groups. User workshops and focus groups. That is another way. The fourth way is through user testing and feedback sessions. User testing and feedback sessions. User testing involving users in testing the system's prototypes, or what we call beta versions, to gather their feedback and identify any issues or improvements needed. You understand? Involving users during the testing phase. That is one way of involving users in system development. So these are 4 ways. Explain 4 ways or approaches used in that would be identify 4 different ways of involving users in system development process. 1, user interviews. 2, user surveys. 3, user workshops. 4, user testing. 4 marks. Those are 4 marks. Then moving on to, that's Roman 1, D Roman 1. Then D Roman 2, what is the question? Explain 4 approaches used in system changeover. 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 What are the approaches used in system changeover? The first approach is direct changeover, or what we call Big Bang. Direct changeover, or the Big Bang approach. This involves abruptly switching from the old system to the new system at a specific date and time, and is suitable for smaller organizations or less complex systems, but it carries higher risks as there is no fallback option. Direct changeover or Big Bang approach. That is one approach. The second approach is parallel changeover. Parallel changeover. In this approach, the old and new system run simultaneously for a period, and users perform their tasks in both systems, allowing for comparison and verification. This approach provides a safety net in case issues may arise with the new system, but it requires more resources and effort to maintain both systems simultaneously. Parallel changeover. Then there is phased changeover. Phased changeover, from the word phases or stages. Phased changeover. Now, the system changeover here is done in phases or modules, where each phase or module is implemented separately. This one allows for gradual transition and reduces the overall risk. So here users again can adapt to the changes in a more controlled manner, and lessons learned from each phase can be applied to subsequent phases. Phased changeover. Then there is the pilot changeover. pilot. Pilot changeover. In this approach, the new system is implemented in a limited area or department of the organization before it is rolled out to the entire organization. This method or approach allows for testing and refining the system based on real-world usage and user feedback before full-scale implementation. So these are 4 approaches used in system changeover. The first approach is direct changeover, the big bang changeover. Then number 2, parallel changeover. Number 3, phased changeover. Number 4, pilot changeover. 4 marks. Now let's have a look at Roman 3. Explain the significance of an information center in an organization. Significance of an information center in an organization. Roman 3. Significance of an information center in an organization. The first is information management. Information management. That's the first significance. Information management. And if you've been attending these lessons, this question has been repeated. We answered it here on the board. And we identified information management as the first reason why an information center may exist in an organization. An information center manages and organizes the organization's information resources, ensuring their accessibility, accuracy, and relevance. It also helps in storing, categorizing, and also retrieving information efficiently, enabling easy access for users. That's what takes place in information management, and that one is done by the information center in an organization. Knowledge sharing and collaboration. The information center serves as a hub for knowledge sharing and collaboration among employees. It also provides a platform for sharing best practices, lessons learned, and expertise across different departments and teams, fostering a culture of collaboration and continuous learning. Knowledge sharing and collaboration. The third point, decision support. Decision support. Information centers provide timely and relevant information to support decision-making processes at various levels in the organization. It may also consolidate data from multiple sources, perform analysis, and presents insights and reports that aid in informed decision-making. Training and learning is the last point. Training and learning is the other point. Significance of information center. Training and learning. Information centers may offer training programs, workshops, and resources to enhance employees' information literacy skills and promote continuous learning. It also helps employees in staying updated with latest industry trends, technologies, and best practices. So these are 4 reasons why information centers are significant in organizations. Information management, number 1. Knowledge sharing and collaboration, number 2. Decision support, number 3. And training and learning, number 4. This would earn 2 marks. The question was not explicit as to many points, how many points to give, but I've given you 4 points, that would mean just 2 points would enable you earn the 2 marks. 2 points, 2 marks. And that brings this lesson to a close. We've answered August 2022 question 7. We've done question 1 up to question 6 in the previous sessions. Today we concentrate on question 7, which we have done. Thank you for attending this lesson. We will continue to provide solutions for ICT. In fact, our endeavor is to ensure that all questions have been answered. And for you to access these questions, you can simply visit our website, www.manifestedpublishers.com. Then after buying the subscription, we allow you to download the content so that you are enabled to use the videos without internet connectivity. Thank you. God bless you. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Ningwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year 1 projected project cash flows is 25 million, the annual cash flow growth rate from year 2 is 10 million, the project life is 5 years. You are required: A, compute the following project metrics: payback period, number 1, number 2, the net present value, assume a discount rate of 12%, number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return. And this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. And this solution over here, you can just drag this one down over here. This is A, and this gives us year. So we have the years given to us there from year 0, 1, 2, and of course you know what happens. Once you put it like this and then you have that plus sign like that, you can drag it up to the number of years you actually want like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5. And you can be able to see the project life right over here is 5 years. So from year 0. And we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings. So shillings, put shillings. And we are saying we can put them in thousands. That. All of these need to be put in terms of thousands over here. That. Why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because we're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presentable, I mean. So initial investment is that. Then we have the residue value or residual value. that. And the residual value is assuming that you sell the asset at the end of the project, or after 5 years there. So right here I can put over here, in terms of the residual value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. Cash flows. And you're seeing the cash flows over here, we've been given the initial investment is 100 million. You're seeing the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter, it can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're seeing is 25,000. Not right there, you can put, because this is the residual value, the cash flows here, 25,000. That, and we're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that, and we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then, so here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now after period 5, you expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here, I can write now the payback period. Because that's what we're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we're going to pick plus that value plus this net cash flow here, comes to 75, and then we reduce it. We continue, we drag it because it's got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A, part 1. So this is A, part 1. I can just put it like so. This is A, part 2. A, part 2. Like that. So that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that. Copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy, put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we are linking it like that. And we are saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or in Excel, there's always a way we can be able to get the present values. Always. It's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4, and power 5, like that, we can just go to the to a formula NPV, like that. And we are saying, we open it up right here, and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there, like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions. 13,365,99. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here, part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A, part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use the similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way and put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here, that. So these represent the net cash flows. So this is what we're saying is shillings, so we just delete this and it's okay. But the initial investment picks from here, the net cash flows, that value there. So once we have that, then we can be able to get the profitability index. And the profitability index we are going to get present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here, like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return.